Welcome to CEPS. I'm Cinzia Alcidi, I'm Senior Research Fellow, and it's a great pleasure to welcome you all to this CEPS Intereconomics Annual Conference. I was just reminded by the colleagues from Intereconomics that this is the 15th conference, so 15 years of cooperation. And I have to say I'm proud to share with you that this event has become a sort of a fixture in the Brussels calendar. It's really an opportunity to reflect and to discuss some key policy issues which are really at the intersect between academia and policy making. And I'm delighted to see so many of you in person today. I hope we will have a very rich event. For sure, the topic offers a lot of angles for discussion. Indeed, this year, the conference unfolds against the backdrop of profound shifts in the global landscape. The international economic order, which was long anchored on the US leadership and on the dollar, is now under strain. Escalating global geopolitical trade tensions, but also bigger changes. We'll not go beyond economics today, but bigger changes, which are basically prompting governments, but also markets to reassess both alliances and their exposure to a US-centered system. Broadly speaking, what was really a framework based on stability, reciprocity, and predictability now is really moving towards a more uncertain and multipolar world. And these developments, I think, they are very much reinforced by a combination of two factors. One is really the return of power politics, and the other side, very disruptive changes led by technological change. And these, I think, are really transforming the foundations of our global system, but also reshaping economic relations and really challenging economic models. And I think this shift are particularly consequential for Europe and for the EU. And this is, I think it's in this framework that discussions around economic security, strategic autonomy, but also the evolving role of the euro become central. And these are really the topics that we will be discussing today. We have an outstanding lineup of speakers, both from the US and from Europe. Many thanks to all for making it. And I really hope that today will not only be an opportunity actually to deepen our understanding of what is going on, but we will also be able to contribute to the policy debate with some new ideas. So I thank you very much for joining, and I wish you a stimulating, a thought-provoking conference. I now hand over to Ekaterina Sprenger from Intereconomics. Thank you.
Thank you very much, Cinzia. And from my side as well, a warm welcome to all of you to the 15th annual joint conference organized by CEPS and Intereconomics. My name is Ekaterina Sprenger. I'm Deputy Editor-in-Chief of Intereconomics. And I'm delighted to see so many of you here today, because for me, selecting a topic of our annual conference is always one of the highlights of the year. And seeing all of you underscores that the topic is definitely timely and important. And this is also the kind of debate that, this is also the kind of discussion that Intereconomics has stood for since 1966 as a platform for independent, informed, and timely policy debate. And also we share this commitment with CEPS, which makes our long-standing cooperation especially meaningful. Before we get started, I'd like to mention that the articles based on today's presentations will be published in our January issue, so please do keep an eye out for it. But for now, I'm looking forward to this afternoon's discussions, and we'll get started right away. It is my great pleasure now to introduce our first keynote speaker, Adam Posen. Adam is president of Peterson Institute for International Economics, which is widely regarded as one of the world's leading independent think tanks on economics and economic policy. Before leading the Peterson Institute, Adam served on the Bank of England's Monetary Policy Committee during the critical years following the global financial crisis. Adam is known for his clear analysis of how economies respond to shocks, how institutions shape outcomes, and how policy choices play out across borders. His work is widely read, it's widely cited, and is always clear-headed. And we're looking forward to your keynote, Adam. Please join me in welcoming Adam Posen.
Thank you. Thank you both, Katarina and Sizia. I've had the privilege to interact with both CEPS and Intereconomics many times through the years, but this is my first time being at the conference, and I'm grateful for the invitation. And this is obviously a topic that I think is critically important. And in particular, as I'm going to try to argue, I think Europe has a lot more agency than people often think, and that not necessarily that Europe can replace the better version of the US that used to be there in international economics or make everything better, but that Europe can, through a certain set of policy choices that I think are attainable, make things meaningfully better both for itself and the majority of people in the world. And that's worth doing. I appreciate Katarina's kind words about clarity. I will hope not to sound too despairing, and that's why I start out with my bottom line. I think in reality, one has to accept, just like an earthquake or a hurricane, there's damage, but one can rebuild and one can move on. And I think that's where it's right for CEPS and Intereconomics to be focusing European attention. So do I have slides or do I not? Yes, I do. Excellent. Thank you. So what I'm going to do is try to draw out and apply for all of you some thoughts I have and had in conversation with officials and scholars over the last few months since I published an article in Foreign Affairs called The New Economic Geography. But this had partly a European inspiration. I don't know whether it's good or bad these days to quote Macron, but anyway, I quote Macron. And I think it's important to think about there's been a peace dividend that's been taken away, but this peace dividend should not be thought of in narrow fiscal terms. It should be thought of as more broadly the order which we have had eroded. So what is the new economic geography? We had an interesting lunch conversation, and Eric made fun of people who use metaphors. So I'm going to use a metaphor. So imagine as Europe, maybe not so much in Brussels, but Europe largely was, imagine you had a beach house like Brad Pitt in Malibu, or like David Hasselhoff on the Isle of Sylt. But anyway, you have a that one went over people's heads. Okay, you have a beautiful beach house, and part of the reason you were willing to buy the beach house, invest in the beach house, even though there's earthquakes, even though there's wildfires, is because you had good insurance, and you're willing to pay for the insurance. Now, due to climate change, due to local government finances, there's more risk than there used to be. And so ideally, you could reprice the insurance and make up your mind. But what's happening is instead, your insurer has decided to start playing real hardball and say, you have to pay triple the premiums. And at any point, I may stop insuring houses on the beach anyway. And actually, we've seen something like this in Florida, but that's more to do with the US. So essentially, risks are going up and your income's going down. And so the result of this is you either need to self-insure, which is inherently less efficient, or you need to reallocate and relocate. And essentially, this is what's happening to the world economy. Next slide. Oops. So I think the way, there's a long history from Kindleberger and Mansur Olson and others talking about public goods. I think the way to think of it is that the US was essentially the insurance provider for the last roughly 80 years. And what I want to start with, and we can get into if you want, but I think you should just take it for granted, this is a fundamental change. This isn't something that will be rectified even if Trump is out. And in a sense, the irony of the alliances, as I put it, is that the more integrated or dependent you were on the US in this situation, the worse off you are from the change. So you think of the UK or Japan or Canada, and then next tier down, you think of France, Germany, Belgium, Denmark, Netherlands. But what the Trump administration has said will happen, is similar to the insurance analogy, is they're just going to keep renegotiating the extraction. And arguably, I don't like putting this in writing, but anyway, it's become insurance. So if any of you used to watch US gangster movies or actually have read US history, there was a racket called protection, where criminals would come up to somebody and say, you have a nice little business here. It would be a shame if something were to happen to it. You should buy insurance. And insurance is you pay them not to harm you. This essentially is where the Trump administration is going in terms of its trade policy at a minimum, but other things. And a key point, which I made many years ago, and which Barry Eichengreen and co-authors made in much more sophisticated econometric terms, is that, particularly on the financial front, people don't seem to always think about this, the security relationships and the economic relationships reinforce each other. Part of the reason the dollar was dominant is because of the security relationships. And so to put it in terms of much of the economic debate, there was already outstanding a shortage of safe assets for all the savings in the world. But what's happening now is a bunch of what were thought to be safe assets are now becoming less safe. So this has a number of economic implications. There's an ongoing rise in uncertainty. President Trump follows what the Nixon people called the madman theory of foreign policy, which I wrote about around a year ago. And this is going to ripple out through the world economy. And a lot of the focus is on trade, but I think it also importantly affects interest rates, it importantly affects deficits, it importantly affects migration and FDI flows. And the key point is that both China and the EU have opportunities with the US withdrawal, but that doesn't assure either China or the EU a role. It doesn't assure them gains. You have to do something affirmative to take advantage of it. So just to review the bidding, if you had invited me this time last year, I'm not saying you should have, but if you had, I would have given you what were my presentations about what was going to happen under the Trump administration. This is basically a summary of them. And I and some colleagues at the Peterson Institute basically got the call right, that they were going to put in place tariffs, that it was going to be 15% across the board, that it would be more punitive for China, that there were going to be 4 or 5 strategic sectors, steel and aluminum, pharmaceuticals, autos, semiconductors, and that this would be linked to demands for FDI, for arms and energy purchases. And so when everybody kept talking about the uncertainty of Trump, I think that was mistaken. There was a very clear program. The fact that they had a consistent program doesn't mean it's intellectually consistent. And as a number of my colleagues, particularly Maury Obstfeld, have pointed out, a lot of the things they're talking about doing on the macro side go in the opposite direction from what they're trying to do on the trade side. Open economy macroeconomics is not their strong point. But there was a consistent worldview basically on this insurance idea that the US had been getting ripped off by providing insurance and had to renegotiate. Now, it's very odd because insurance can actually be a very profitable business. And interestingly, I would argue on the security but also the economics front, the US had a particularly good business model because when it extended insurance, it actually would sometimes meaningfully reduce the risks and therefore the chances it would have to pay out. So if you think of NATO, if you think of protecting commercial shipments, if you think about creating an environment of intellectual property right protections, it's not like a property and casualty insurer in California. They can insure against a fire, a wildfire. That doesn't reduce the chance of the wildfire. But if the US, as it was for a long time, protects a property right, protects a border, it actually did reduce the risk. So it's just fundamentally wrong in an analytical sense for the Trump administration to believe that the US was getting a bad deal, but they do. And that is the unifying theme here. So I'm pointing the wrong way or something. There, okay. So I don't need to dwell on this for this audience, but the uncertainty remains. It's like Brexit, and we've seen this. So if you take away all investment in the Mag 7, there's been essentially zero investment in the US, and it's not because of credit constraints, and it's not because there isn't deregulation or high profits. It was in part because of the uncertainty created, again, not just because of tariffs, but because of the Trump administration. And so we do have a world in which the US over Trump 1, over Biden, over Trump 2, the US has meaningfully reduced its imports from China. My colleague Chad Bown has done a lot of work on this. And China did shift to new markets. And as another colleague, Arvind Subramanian, has recently pointed out, despite the fact that Europe feels itself put upon by a China shock, the real China shock 2.0 is for the developing world. They are getting huge dumping of very cheap industrial goods, and they are being shut out from opportunities to work their way up the industrial ladder by China. But meanwhile, the EU did over the years, and this is work done by my colleague Mary Lovely, its reliance on Chinese tech. So you're all familiar with that trade picture, but let me go back to the US dollar. And there was always a question why the US dollar was so dominant when its share of world GDP was declining and its share of world trade was declining even faster. And there were various problems in the US. And I've been saying for a long time, there were two open secrets about what was keeping the dollar central. The first was, of course, the lack of viable alternative, or as I put it in more Keynesian terms, it was a least ugly contest. So it wasn't that the US dollar wasn't getting more ugly over time, it was that the euro, unfortunately, and certainly the Chinese renminbi were not getting more attractive. And in fact, a key point is the next bullet point, that even when things would go wrong in the US, after an initial adjustment, generally money would flow into the US because you figured whatever else happened, the Fed would react, the Congress would react, and you'd be safer in the US than the effects of what happened in the US. But the other point is the security regime, that the US dollar was disproportionately used and held by countries in alliances or military relationships with the US. And so what we have now, since the arguably not just the April Fool's Liberation Day tariffs, but the Vance speech at the Munich Security Summit and his speech the prior week in Paris, is an unraveling of this. And as Ellen Ray of London Business School has analyzed, and Maury Obstfeld has analyzed, and others have picked up, what you've seen recently is more of an EM dynamic in the dollar. The dollar hasn't crashed. The dollar is not ceasing to be a reserve currency. But when there's been negative news, instead of interest rates and the dollar going down simultaneously on the assumption the Fed will take care of it, what you've seen instead is interest rates going up as the dollar goes down, which is what happens to most countries, but has not historically happened to the dollar except in the late 70s, early 80s. And so I won't go through all this, but this was back in 2008. I argued about why the euro will not rival the dollar. And I pointed out that countries like Taiwan and Saudi Arabia and Panama were not picking the dollar for economic reasons, but for security reasons. And if you just talk about network effects, you're basically labeling a residual. And as I mentioned, Eichengreen, Mail, and Chitu picked up on this and did a more econometric version of this and came to the same conclusions. And so now, imagine we do that into reverse, and Europe starts taking more responsibility for its own security, starts spending more on dollars, starts creating alliances potentially of its own with Ukraine, with places in Southeastern Europe, potentially with the Med. You could see a reversal of this. And my colleague, who many of you know, Jacob Kierkegaard, who's resident here in Brussels at Bruegel, covers some of these issues. So that's the broad picture of the new economic geography, that the world has changed. There's a lot more I can go into. I encourage you to read my article. But let me turn, for this conference and in hopes of provoking discussion, let me turn to more specific European aspects of this. So I think what's in particular, and by risk here, it doesn't necessarily mean something bad. It just means more uncertainty, and Europe has to deal with it. So obviously there's trade conflicts. I think an important point is diverging standards. So we've had a period where the US had a disproportionate influence on standard setting, both formally, legally, and also informally. And we see this most obviously with the US going its own Sonderweg on internal combustion or hybrid engine autos versus many of the green choices that Europe or China or others are making. We do have, as I mentioned, a reduced safety of dollar assets, and what I and Maury and a few of us at Peterson call the decentering of the dollar. And I think that's the right word, that the centrality of the dollar is being reduced. It's not the dollar is crashing or being thrown aside, but it's less central. I think there's also a fact that, leave China out of it, India, Brazil, Indonesia, possibly Mexico, Poland, if you want to consider them, Turkey. The largest EM are getting, basically the G20 EM are getting more important. They have a combination of security and economic weight. And obviously some of these countries, notably Turkey, of course, have a very big influence on Europe. But I think also, and this is something I really want to flag as a former central banker, I think that there is a real divergence emerging between European and American approaches to financial supervision. We were chatting earlier about what's going on with the Fed, and I think people are understandably but mistakenly overly focused on the independence being diminished having inflation risks. Whereas what I'm particularly worried about with the Fed is the independence being diminished, creating financial stability risks. And Europe, the European system of central banks and supervisors, to their credit, I think are not going to indulge in the same kinds of lax supervision the Fed is already on the way to doing. But I think this divergence has to be taken seriously, both for the dangers and for the opportunities it presents. So that's the big picture. Again, there are people in this room who are more expert on this than I am, and I have colleagues who work on these issues. But you can see a world where, in addition to the other forces that lead to fragmentation of production and trade, where you start having divergent standards. And this includes on food and agriculture, where we've long had that. But I mean, just imagine we've gone from a world where 15 years ago, 10 years ago, we were repeatedly talking about attempts to get Europe and the US to have mutual recognition of standards in various industries for the sake of trade and investment, to a world where we're going to have less of that. And this includes things like data privacy and ownership. This includes, obviously, green factors, as I mentioned. This includes, I'll come back to the issue of digital currency and stable coins. Again, the reason we have trade deals is not to create jobs and not to create markets. That's what politicians say. That's not in the data. The reason you have trade deals is to manage better and avoid future problems in pre-existing economic relationships. One can see this with Brexit. That the issue is not, the losses are in part because there isn't a good way of managing the UK-EU relationship yet. And so I think we have a situation here that's going to become important. Now, again, this is two-sided. A world where the US is not setting standards or is behaving in a very self-interested way in both the normative sense and just literally focused on itself is a world where Europe can play a bigger role in setting standards, where other economies and markets may want to follow European standards. But you have to think about that. I think an issue which is potentially important, and again, Eric or Daniel or others who have more macroeconomic chops may want to disagree, but I think it's useful to think about something of a diverging R-star or basic rate of interest. And Luis Garicano at LSE had a nice piece on this. I don't always agree with him, but I thought this was good. I mean, basically, imagine a world in which, despite all the awful things the US is doing to itself and others, AI is for real. You know, it's solo exogenous technological progress. Trump hasn't messed that up. And Europe, for many of the same reasons talked about in the Draghi report, and which we saw during the late 90s, early 2000s, is less able to adapt its labor markets and businesses quickly to the new technology. So imagine you have a world in which the real return to capital on average is going up in the US, even if over the medium term it's going down. And Europe has somewhat integrated financial markets, but doesn't have the same rise in real return. You end up with a big wedge. Also imagine a world, and this is point 2, in which capital flows between savings-rich Asia and savings-desperate US and Europe are diminished. So the savings glut that Ben Bernanke spoke about 20 plus years ago essentially goes into reverse or gets moved. So you still have a savings glut in China and certain other parts of Asia, but it's not coming to the US, it's not investing in Europe to the same extent. Then you have a disinflationary, if not deflationary force in those parts of Asia. I think a key point, which Europe is point 4 on this list, which Europe is well positioned to take advantage of, but again has to think about. If the US is going off on green technology or on food in directions that are not the way the rest of the world goes, then there's more room for Europe to become a standard setter and to have its technologies diffuse across the world. From a development perspective, I'm very unhappy about this because we're not going to, it never would have been perfect, but where you're much less likely to get a merit-based outcome where the top 1 or 2 technologies become dominant across the world and become cheaply available, irrespective of national origin. That's much less likely in this post-American world economy. But again, in the same spirit, taking that as given, there is a potential win-win where Europe advances development, advances the diffusion of cheaper green technology by opening itself up, by making its standards accessible, by changing some of its trade and investment policies, whereas the US throws up all kinds of restrictions and people may or may not want Chinese tech. I've already talked about this, so I'm going to skip over it. The last point I want to make is point 6 and 7. And this is something where, to their credit, I think President Lagarde and others at the European Central Bank have actually been quite frank. That the swap lines, which are not the be-all and end-all of everything, but are both important and important symbolically, that the Fed has had with major European and other democratic central banks in advanced economies are probably somewhat in question now. These are, of course, the lines that central banks use to provide dollar liquidity to their systems when there's runs on the systems, when there's problems, like in 2020 at the start of COVID or late 2008. And yes, officially the swap lines are still there. In the spring IMF meetings at the G20, I've had reported to me multiple times, I was not in the room, but Jay Powell made a big point of standing up and saying on behalf of the Fed still controls the swap lines, don't worry about it. And basically elbowed sharply Treasury Secretary Scott Bessent, and Scott said, yeah, swap lines are still there. But of course, this is one of those things, like so much in central banking, when you have to reassure people, that's the problem. So you have to think about the mental experiment of like the infamous picture of Kamdesu standing over Suharto as he signs the agreement. It's not so much Scott Bessent or even others in the Trump administration are going to say, no, we want to close down the swap lines. It's, can you credibly believe that when push comes to shove at the last minute, if you need the dollar swap line, the Treasury isn't going to grab the Fed's hand before they push the button and say, but we have a condition. We want you to invest 22 billion trillion in the US. We want you to recognize our stable coins. We want you to whatever. And so I think the ECB is right, and in fact should, with even more urgency than they currently are, be working on developing alternative forms of swap lines, as well as longer term making the European financial system less dependent on dollar liquidity. And that, by the way, that's bad, right? I mean, that's bad for economic efficiency versus the status quo ante. This is not something I'm recommending like, oh, this will be wonderful. But I am recommending it strongly, pardon me, as a response to the situation. Let me skip over this. So finally, and I've just written something on this, it's not yet published, and I spoke about this to European Systemic Risk Board in September, I guess. We have a world where part of the new economic geography is increased interest in alternative assets. This is gold, this is timber, this is small country overvalued currencies from Norway and Switzerland and Singapore and New Zealand, but this is also crypto and weird new assets. And I think this isn't economically driven. This is a general response of the disaffection that we see in the US and in other Western democracies with government authority, with technocrats. And we're all aware of how out there in the social media there was already fertile ground going into 2008 for conspiracy theories about fiat money and central banks, but it, of course, has only gotten worse since then. But additionally, there are real issues that if the US government or the Chinese government are busy saying, well, there might be a situation where we are not going to allow Chinese or Americans in and out of our markets very quickly, the way we used to, or we're going to tax differentially sovereign wealth funds from domestic funds, or sanctions are no longer about the occasional individual Russian oligarch. They potentially could be used quite widely. In any of these situations, you have understandable desire to not be caught up in dollar assets by a lot of people. And as Marcus Brunnemeyer, Harold James, and what's his name, Landau, talked about with central bank digital currencies, this is a world where potentially if you're advancing this technology, this fintech, if you're somebody who has money in El Salvador or has money in Nigeria or whatever, I don't mean to pick on those countries, pick your favorite country, there is a risk of easy capital flight. But then we have the new angle that the US Treasury has announced they're going to push hard on stable coins, which will be backed by US Treasuries with explicitly in mind they want to sell a lot of short-term US Treasury bills to foreigners. And implicitly, they're going to increase supply, but for it to do any good, it has to also take a larger share of world assets to keep interest rates neutral. I didn't put this on the slide because I figured you all knew this, but just to be clear, the ECB, again, in my opinion, rightly, but the ECB is being much more cautious about these things. And additionally, the European governments have not hamstrung the ECB from having a digital euro and having these things. Whereas what you may not be aware of is that in the US, the Congress passed the maxi-moronic called Genius Act. And the Genius Act includes various measures to try to promote the sale of not just stablecoins but crypto assets in the US, but also explicitly forbids the Fed from having a central bank digital currency, that it must be done in the private sector. And so we have this weird mirror image now, transatlantic, of the ECB, also the People's Bank of China, is developing a public central bank controlled digital currency and being very cautious about the supervision and development of stablecoins. And the Federal Reserve, or more importantly, the Treasury, with congressional support, is not in the digital currency business at all, but is going to have to deal with a world in which there's a huge issuance of stablecoins, mostly from private sector entities. And so I'm sorry to belabor this, but we were talking, and somebody was saying quite reasonably that, you know, you're not going to get a huge shift out of dollars. You're not going to get a huge change until there's some kind of crisis, until there's some kind of provoking event. This may be it. And so there was recent reporting in the New Yorker, there's been other reporting since, that the Trump family and their associates have an estimated at least $3 billion of stakes personally in the development of crypto assets. And again, this isn't illegal. And I want to be very clear, the reason we know about this, we don't know about all of it probably, but the reason we know about this is because the sons of Trump, the children of Howard Lutnick, the Commerce Secretary, the children of Witkoff, the Middle East Ukraine negotiator, just to name 3 senior officials, have publicly taken interest in these firms in a big way. Lutnick's former firm, Cantor Fitzgerald, in which he has not left out, not gotten rid of any ownership stakes, has an enormous interrelationship and ownership stake back and forth with Tether, which is a platform for dealing in these things. So even if they're totally motivated by good reasons, and even if it's just totally above board, this creates a huge impression in people's minds that these firms are favored, protected, subject to bailout, systemically important. And so for me, the nightmare, which has some rough parallels to the small banks in Europe in the pre-crisis era 20 years ago, is you get a bunch of firms that on the one hand are issuing or holding or providing a market for US Treasury stablecoins, but at the same time, the same company is issuing, selling crypto of dubious valuation, and that same company is part owned by families of officials in the Trump administration. And I normally don't get into this kind of micro stuff, but we have that on the one side and the mirror image in Europe on the other side, and this strikes me as a place where we could have a crack up. And again, Europe, I'll before ending on a more happy note, I'm going to give you the required get your act in gear statement. The ECB and others are moving faster on this than they've ever moved on anything like this before. That's not good enough. So I know that our 2 hosts at least know, I hope many in the room know, that I have always been a Euro bull, a Europe bull more accurately. I am not somebody who sits in London and says, you know, or in Palo Alto and says the Europeans never get their act together. But at some point, there comes times when it's not enough to say by historical standards we're moving fast, or the US, when it integrated from 1820 to 1920 took 100 years, or that's not the point. If Europe at a minimum on this issue, similar to in the security sphere on Ukraine and Russia, does not have its own freestanding capacity for liquidity, have some self-sufficiency and insulation from US financial market spillovers, is not in a position to provide security to near neighbors, in this case in the financial market, is unwilling to become a partial insurance provider, it will actually go very badly for Europe. Whereas if Europe seizes the moment, it actually could go well. So that leads into my positive encouragement, that we need more Euro and more Europe to pick up some of the market that has been left behind by the US withdrawing from being an insurance provider. So I've been saying for a while, and I said it last time I was in Brussels was, well, actually I wasn't in Brussels, I was remotely in Brussels, last spring at the Brussels Economic Forum. And my main message, and I put it even in a German paper, is Europe should not try to play the Chinese and the American game. There is a temptation, and I was in Denmark, I was in Copenhagen last week and talked with some officials there. There's this temptation to say, look what the Americans are doing, look what the Chinese have succeeded with. We need to have this kind of industrial policy. We need to have this kind of pseudo-empire, although of course they don't say those words. We need to strike back as needed. To me, that is a mistake. Europe cannot compete in a bullying war with either China or the US for a whole host of reasons. Europe will do better by leaning into what it already does. And so Europe's way forward is to be to itself. And so you want to reach out in what I would call principled plurilateralism, essentially make deals in trade, but in other places in a multilateral spirit, meaning rules-based, open admission to people who make standards, keeping it transparent, but not waiting for every veto player at the WTO or wherever to do it. Avoid the arms race in industrial policy. I'm sorry, particularly for Germans in the room, I don't care that China has 90% of the world solar panel market, and you don't. I care that China has 90% of rare earths, because that's an input. Solar panels are transistor radios of this decade. They're just a cheap output. You got to distinguish between these things. And I think what you will gain from what you already have and are gaining in relative terms is being more open than the US has become, being more open than China has become, is to your advantage. The talent you will gain, the investment you will gain, the variety you will gain, the diversification you will gain, the soft power you will gain is enormous. And I think one thing which people forget, especially as one looks at markets not moving very much, is just at this point in the developing world, how little sentiment there is either for China or for the US. In Europe, and it saddens me greatly, but I completely understand the sense of loss that the US, which had been, let us say, older sibling in a sense since the war, has let us all down. It certainly let me down. But it's not the same as the Venezuelas, the Lebanons, the Irans, and so on around the world. And no one should kid themselves about China being terribly attractive. A final caution, though. There will be, and this goes to something Daniel Gross was saying earlier today, there will be a sense, and this is inherent anywhere, this isn't unique to Europe, that the excuse for any of this becomes, well, let's spend more and let's centralize and that'll take care of our problems. And unfortunately, the Draghi report has mostly been reduced to this one word, scale. And that, frankly, I think is misleading. It's about adoption and diffusion of technology. Scale's only one component of that. And I think going back to the discussion of standards that I mentioned, but also of Europe playing its own game and being open, that Europe has a better chance of adopting and diffusing technology and then becoming the purveyor of widely adopted and diffused standards of technology and networks around that in a way the US and China will not. And so let me leave it there. Thank you very much. I don't know whether we have time for questions or whether I blow through all my time and I will get off the stage.
We do have time for a couple of questions. Thank you very much for this excellent presentation, Adam. That was very interesting. We will collect 2 or 3 questions, or
oh dear, in Britain, very interesting means bad. So I will hope. I will hope that's not.
This is absolutely not what I meant.
Yeah.
No.
Thank you. I'm just joking. Sorry.
Thank you for your presentation, Sergei Kasyanov, Harvard Aerospace and Defense Alumni Organization. You advise Europe to avoid the arm races in industrial policy. Do you mean Europe should not rearm?
Oh, no. Sorry. No. Europe should get nuclear weapons as soon as possible, in all seriousness. No. I'm sorry. I meant, it's a bad metaphor. Sorry. Misleading metaphor. What I meant was specifically, there's a security reason to make sure you're not dependent on all your chips for one hostile place outside of Europe. There is an economic reason to make sure you have engineers who know how to apply and use chips, and with ASML and others, you already do. There's not a pressing need to make sure that there is a European competitor with Samsung or TSMC. There is not a pressing need to make sure that there is a European competitor even with Google. That's what I mean. It is not required that Europe have a national or European champion in every bloody industry. That's not the point. I'm sorry to have been unclear. And by the way, I wasn't joking about the nuclear weapons.
Thank you, Adam. Maria Demersis from the Conference Board. A question on the dependencies, on Europe's dependencies. I mean, if you were to go down and actually enumerate the dependencies on defense, critical materials, digital, and finance, Europe really is depending on the whole of the world. And my question is, how can we ensure business continuity in Europe in the short term, not in the long term, without some sort of an industrial policy? Yeah? By that mean, you go away from market forces and you use other tools.
Yeah, no, it's a very fair question, Maria, and thank you for engaging. I viscerally react to the name industrial policy, but I agree, there are things you need to do both short and long term. I think the first thing to do, which to some degree Europe has done and the US has certainly not done, is whether through the Commission or through places like CEPS or the Conference Board or somebody, creating a genuine technocratic log of where are the vulnerabilities, where are the dependencies, and some multidimensionality to it. Now, as you may know, my colleague Chad Bown at Peterson works on some of these issues, and while he was in the Biden administration as chief economist of the State Department, he tried working with European and Asian allies on these issues, but he ran up against problems in the US government, which I started complaining about in the Biden administration, which was they never wanted to specify what were the vulnerabilities or even what should be the criteria, let alone delegate it to some experts in a public way to do it, because the Commerce Department wanted to exercise discretion over who they gave goodies to and subsidies and so on, and the Defense Department wanted to always be able to say that's important for defense or that's not. So the first thing I think, and again, some of this has already been done in Europe, but I think there's room to do more, is just literally do the assessment. And I think people have to get out of their heads. So again, the metaphors issue. Not everything is semiconductors. I mean, I know you don't think that, but I mean, just to be very clear, there really are only a couple things that are truly critical, hard to replace versus expensive or slow to replace, concentrated in one place, so on. And so triage, so I agree, this is about policy, this is about public decisions, this is about interfering with markets. Just when I say not industrial policy, again, I'm sorry to have been unclear. In a Washington sense, industrial policy is about picking winners. It is about putting money into specific industries and specific companies as a means to an end. And the other point I would emphasize, which again, you're absolutely right about Europe's assessment, one has to realize that foreign dependence is not necessarily better than self-sufficiency, right? And again, I think you know this and other people, but it has to be explicitly said. And, you know, Alan Beatty, the great trade writer at the FT, who's I think here in Brussels, you know, did some great stuff on this when there was this food shortages stuff after the COVID and the invasion of Ukraine. And, you know, if you go self-sufficient, right, you're subject to what happens if there's a military or terrorist attack on your own domestic source of something? What happens if, like Japan had, you had an earthquake or a nuclear accident, God forbid? What happens if there's a potato blight, like in Ireland 150 years ago? I mean, the point is resilience and diversification, not necessarily self-domestic production. And again, you know this, but I think we have to keep hammering at this, that has to be part of it. And in the US, where frankly domestic violence and natural disasters are, and the potential for foreign attacks are really high, I mean, not high that I'm scared to go through life, but high in objective terms, you know, the idea of self-sufficiency is nuts. As big an economy, as diverse an economy as we have.
There's another question from.
Yeah, thanks a lot. Not only interesting, but great talk. There's one question which is being debated in Europe, and also you've seen perhaps in the FT today. Now, we have lots of trade between, let's say, the three major regions, US, EU, and China. And then the question that always comes up is who depends on whom for what? And the most of the geostrategic attention is on we import certain materials which might be critical, and so we have to identify those materials, as you said, that have a low elasticity of substitution in the short run. But other people say we depend on the US as a market, right? Which then means actually, in terms of, if you look at the statistics of goods where the EU is the biggest supplier for the US, that is much more frequent than the other way around, right? Because we are a much bigger exporter than the US. So you can't have it two ways, right? You think you depend on imports, whereas other people say you depend on exports. Now, where do you come down? What's the, let's say, geostrategically more important dependency, so to speak, on access to a market or access to certain imports?
Thank you. Very interesting, astute question, Daniel. So, no, I have a clear answer. I'm just worried it's going to sound facile. Imports matter, exports don't. Full stop. From a geostrategic or even a long-term development point of view. If you're a small developing country, you export because you don't have scale, you need to get up to global practices. There's a huge literature, as you all know, on this. It's about importing best practices, putting competitive pressure on your economy, importing technology, getting access, but ultimately it's about getting access. The importing in the broadest sense, and when Maria bringing up financial dependence, which I didn't address directly, was equally important. Getting sustained credit lines. This is why developing countries exporting, this is why all the Asian tigers in the first 10, 15 years of China's development they were exporting in the classic sense of being able to import and being able to get access to other things. Germany or the Netherlands or other export-oriented parts of Europe, they don't have that problem. If you lose exports you know, it could have happened for 1,000 reasons. It could have happened because, I don't know, VW turns out to have been lying about diesel and poisoning people, and therefore they should not be saved. You could say the same thing about Boeing lying about planes falling out of the sky. So it's not, you know, you don't want, it is a very real and costly thing to have exporters who are deemed too big to fail. Whereas I think it's much more limited than either the Biden or the Trump people think, but there are a few things that if you can't import them and you don't have a reasonable source of supply, really do matter. So I stand here today without wasting your time with my details, but probably obviously I am a beneficiary of contemporary pharmaceuticals. Turns out, if you go through the supply chains, some enormous percentage of the feedstocks and inputs to even generic pharmaceuticals around the world come from China. And it would be basically hundreds of thousands, if not millions of people, and God forbid, and myself included, could die if the Chinese decided to cut these off and we don't have alternative production. There are geostrategic imports. As I said in an article about why China had escalation dominance in negotiations with the US, if China loses access to the US market and loses exports, it just loses money. Money is fungible. You can substitute. That to me is the key difference. Thank you.
We'll take one last question if possible. Sorry, sure. Because I nodded already. I know we started 5 minutes later, but okay. I mean, thank you for keeping an eye.
Thank you very much. My name is Zheng Yu. I'm from the Mission of China to the European Union. It's such a great honor having this opportunity to listening to your presentation and ask questions. And I agree with most of your conclusions a few minutes before. And I got this question because, sir, you mentioned you advocate for the increased self-insurance for the European Union. And it's obviously beneficial to this unstable, multi-centered world. But meanwhile, it also means increased strategic autonomy for the European Union and also reduce the leverage of the United States over its European allies. And would that be worrying you, or how would you reconcile these two dynamics? Thank you.
Thank you very much, Minister. I first should say you surprised me. I thought you were going to go in a different direction. I thought you were going to say, do we have to accept this multipolar strategic autonomy world? Can't China and Europe work together to create a nicer world? So I'm glad you didn't do that. And second, I sincerely thank you for taking the time to listen today. I have a lot of interaction with the Chinese embassy in Washington, as well as with Chinese economist counterparts, and talk about how China is thinking about adapting to the new economic geography. But ultimately, I'm going to say something that I believe sincerely and which makes me very unpopular in the US. Yes, I am a US citizen. Yes, I was born in the US, but ultimately my advocacy for the sake of the US, beyond fellow feeling of my family and friends, is based on what kind of world the US is creating. And I believe, on balance, including with the reconstruction of Europe after the war, including with the reintegration of Eastern Europe and Eastern Germany peaceably after the Cold War, including with the rise of China, which was certainly done by China, but enabled in part by US, in the first 15 or 20 years after Deng Xiaoping took control, were genuinely good things for the world. And as I'd argue, even if they were certainly worth it, even if it supposedly cost the US something, but I would argue it didn't really, it was win-win. And there were various times the US exploited its position in self-interested, small-minded ways, and there were various times allies as well as others took advantage of the US or free road. But until roughly 2014, plus or minus 2014, 15, 16. In my view, the US was largely a benevolent hegemon. The world largely wanted to be part of that system, and the system was self-replicating. And basically, midway through Obama's second term, that started to unravel in the US. And it's going to have to be historians, not me, who figures out why. I have hypotheses, but I'm not going to waste your time with it. But then actions by the first Trump administration and by the Biden administration set us further and further down that path. And so ultimately, I will not advocate for a US that is not a force for good in the world. I will advocate for the US right to maintain its security, to maintain its nuclear deterrent, to maintain its military. I have a far, far narrower view of what the US has to do vis-a-vis China and vis-a-vis the rest of the world in order to maintain its security than many in Washington do. And I'm just very sad, profoundly sad, that the US has gone down this road, and I am trying my best to find ways to convince people to go a different road. I'm sorry to be so emotional, but this is why I'm in this game, because I think it is just wrong, the path the US is going down. And I want Europe, I want, for that matter, the people of China, maybe not necessarily the Chinese Communist Party, but the people of China, to not be harmed by the US doing this.
Thank you very much, Adam. Thank you for this presentation. And I would like to invite the speakers of our first session to yes, please. And also, there's still some seats here, so feel free to sit down. You don't have to stand there. Yes? So I think it's going to be perfect continuation of this very rich start. It's welcome to session 1 on Europe and the euro in a changing global economic landscape. And I think we all agree that Europe has huge long-term investment needs. And the real question is not just how much we need, but also where this capital will come from, and also how we organize our financial architecture to channel it effectively. And each of 3 distinguished speakers of this panel brings a different piece of this puzzle to help us tackle these questions over the next hour. It is my great pleasure to present Roel Betsma, who is the Dean of Faculty of Economics and Business at the University of Amsterdam and Professor of Macroeconomics. Kalien Anef-Janse, who is Chief Financial Officer and Member of Management Board of the European Stability Mechanism. And Judith Arnal Martinez, who is a Senior Fellow at the Elcano Royal Institute, a Board Member at the Bank of Spain, and also an Associate Senior Research Fellow here at SEPS. So, with increasing global uncertainty and questions about dollar dominance, can Europe realistically become a global reference point for safe assets and use that to fund its long-term investment needs? Under what conditions could that happen? And perhaps more broadly, what are the most important steps the EU must take to channel both foreign and domestic savings into productive long-term investment? So with these questions in mind, I'd like to start with the global perspective, maybe, the international one, and I would ask Kalien to start with his presentation.
Let me see yes, it works. So hopefully I'll start with a more positive message after we ended a little bit in a more grim mode, and I want to bring some of the enthusiasm back because I do have a little bit a more positive view where the future is heading to, and let me kick that off in that way. So let me start a bit where the previous speaker ended, where Europe has some key strengths. And one of those strengths is that several years ago, when we spoke about Europe uniting, creating Euro bonds or European safe assets, people would say this will never happen in our lifetime. Guess what? If you go 15 years ago, we only had around 400 million of European safe assets in the market. Today, it's 1.4 trillion. I spoke at this conference 2 years ago, and back then we were below a trillion. So we actually have seen this skyrocketing amount of European safe assets coming out. What you see is that in every crisis that we had in the last 15 years, we got more Europe. So 15 years ago, after the great financial crisis, the Eurozone crisis happened, and then my institutions, EFSF and ESM, that I represent, were created, and they brought 300 billion of safe assets in the market. Then the COVID crisis happened, and then NextGen EU and SURE was created, and they brought almost 800 billion into the market. And this year, we created a new product on a European level, the SAFE product for defense and security, and that will bring another 150 billion into the market. So we have seen that over time, the European safe assets have grown to become the 5th largest country in Europe, and we soon will also pass Spain. So it will become the 4th largest country in Europe if you look at how much debt is represented. Now, what I also find interesting, if you then look at the different countries that we represent, how they behaved in this more Europe that we are getting. So if you look at Germany and for me as a CFO, I do like to watch numbers and spreads, and as I trade both as an investor, as an issuer, what you see is that Germany was, of course, in the beginning a bit hit in their spreads when they announced the big defense package. So that helps themselves to invest more in defense and infrastructure, but also supported the EU SAFE. And then by the tariffs that were announced on the 2nd of April by President Trump. Now, despite some volatility, at the end, the spreads are pretty much the same as they were before that volatile period. So it means that the safe asset of Germany is actually working quite well, despite all the geopolitical challenging that is happening that also the previous speaker indicated. But then we need to look at what really is changing. So if you look at the left side, you actually see that some countries that we first thought, well, they might not be doing that great, like Italy, have seen a huge contraction in spread levels over the last year. So we started the year that Italy had a spread level of around 120 basis points over Germany. Guess what? It's now down to around 75. France, we all know the volatility that happens around their budget. Yes, they went a little bit above Italy, but still, if you look at the entire year, they're still between this 70 to 80 basis points spread over Germany. That doesn't sound like a big crisis. It means that the European core countries are actually performing well, and international investors like them. Now let's move to what I find a very interesting story is if you look at these European safe assets. So this is ESM and EFSF, the institutions I represent, the European Union as an issuer, and also the European Investment Bank. Over the last year, they actually have seen a huge contraction of the spread levels, and they're slightly around 20 basis points over Germany. So they're moving closer and closer to this AAA asset, which we see as the core of Europe's financial stability. Now, let me also look at the countries that in the past we thought would not do that well. Ireland, Portugal, Spain, Cyprus, and Greece. All of them have seen over the last year a huge contraction of their spread levels. If you look at a country like Cyprus, from almost 120 basis points over Germany down to 30 basis points over Germany. These are also the countries we helped during the Euro crisis and benefited from our financial support. And if you look at their financing at the moment, a country like Greece pays around 1.5% of that financing cost through us. It's one of the lowest in the entire Euro area. So the reforms, restructuring, the carrot and the stick really worked. And you can see that in the numbers and the investor trust. also all these countries have seen upgrades over the last year. So rating upgrades to investment grade and even above that. Now, where we need to ask ourselves in Europe is, where do we go next? I'm using here a presentation by the governor of the French Central Bank. He gave that at the ESM roughly 2 months ago. Katrina, you were at one of these events, so thank you also for joining that. So basically what he looks at is how far is Europe versus the US. So if you look at the US with almost 30 trillion of US debt in the market. In Europe, we are below that. So if you look at the higher rated, it's 10 trillion. If you look at the safe assets, 1.3 trillion. So we need to work on developing a European alternative or additional complement to the US Treasury if we want to see larger global shifts. Now, there are benefits of doing things together. And I like to plot the spreads or the sustained spreads on how they perform at the moment. And if you look at it, is that, and I'm quoting this one, but maybe this is the better one. Germany, Netherlands, and Ireland are the best priced in the market. And then it is the ESM and very quickly the EIB. So the safe assets are really trading as close as possible to the most strong European nations. The one that is a little bit more worrying, of course, is France. At the moment, it's trading close to Malta and Lithuania. So for them, it also makes sense to do more common borrowing. But even for countries like the Netherlands and Germany, it would make sense if you would borrow on a European way for European common goods. And with RU, we have made some publications earlier this year that even for the Netherlands and Germany, it can be made cheaper because the weighted average of the ESM or the EIB is below what Europe as a general pays. So you could have some discriminating financing so that the Netherlands pays a little bit less and Germany, while the other countries a little bit more. So all the countries of the euro area can actually borrow cheaper if you do that European-wide than if you do that nationally. Now, we spoke a bit about changing patterns. And for me as the CFO, I travel the world. I was 2 weeks ago in India, in Saudi Arabia and in Oman. I was earlier in Japan, but also in China, where I speak with the central banks and also large investors to see how they can divert and change some of their investments. And what you see is that we have seen since the 2nd of April a real switch off of the dollar by international investors and a switch into European government bonds. I don't use here my data. This is from a JP Morgan report that came out in October ahead of the IMF World Bank meetings. And you see that they are trying to rebalance and shift some of the dollar holdings away from dollars into European sovereigns. And I'm quoting here also what JP Morgan mentioned in that report ahead of the IMF meetings, is that if you look at trade-by-trade basis, on the monthly basis, there is a switch off of US dollar and a switch into European safe assets. Now, the problem that we still need to solve is size. And I'm going back to this presentation of the governor of the French Central Bank. So he presented that there are a few options. One is to use securitized products like the SBs and the red-blue bonds, which were proposed a few years ago. There was an idea to merge all the European safe assets and also to boost the number of next-gen EU bonds. But I think we can actually do more. If you look at the free capacity that EIB, European Commission, ESM can do, you actually can supersize the European safe assets if you want to. And I see a political momentum growing. So we've seen that countries that in the past were a bit more hostile to common borrowing, like Denmark and Finland, were part of the 19 countries that this year signed up to the SAFE product, because they do believe that it makes sense to defend Europe together, not by individual countries. A second change that I see, and I'm Dutch-Bulgarian by background, is that in the Dutch elections, there were 2 parties that won most seats, and both of them speak about more Euro bonds, European safe assets, especially for European public goods. The German government also supported this drive by Rearm Europe of 800 billion and supported the SAFE product. And then we have an institution like the ESM that has still ample capacity to disperse more if there is a wish so. So at the moment we have around 430 billion available lending capacity. Now there are many academics, practitioners that are looking, and Judith is actually one of them, and how you can use that big capacity. And one of them, Lorenzo Bini Somaghi, he is the former board member of the ECB, now chairman of SocGen, came out with an idea how you actually can leverage and supersize the ESM in order to become a European safe asset issuer. By using leverage and by us buying European debt in the market and issuing safe assets into the market, and we are the most capitalized IFI in the world with 80 billion paid in capital, 620 billion callable capital, you can, and I'll go to the next slide, and the computer is stuck, I think. Here we go. You can actually, at a issuance of around 2.5 to 3 trillion of European safe assets without creating new instruments for this, or around 20 to 25% of European Euro area GDP. That would be a really impressive size, and that would make European safe assets really as big as the largest countries in the market, France and Italy. You can use this mainly for European public goods because that works politically the best at this moment, and over time, it could be a synopsis for some sort of a European federal budget. So I think we have the institutions without putting in a lot of new financial means in order to create more European safe assets. And now, and the story that where you can look at is how this creates more debt on debt on debt. No, that is not the case. The point that we are trying to make, and this is the article that will go out together with this conference with Roel and myself, is to show that if you do and have more European safe assets, that's a blue line, you actually can start reducing national debt levels. So then together you can create a 4 to 6 trillion European euro-denominated assets into the market, which will reduce costs for taxpayers and tax burdens for all the euro area, so not only for the higher indebted countries. And that would be a real game changer. And I think that's what we should focus on in the next 5 to 10 years. Thank you very much.
Thank you very much, Colleen. Now, Roel, the floor is yours for the initial intervention. Do you have, the mic. I thought it was mic.
Thanks for, now let me see. Yeah, okay. Well, I don't know whether that is the most recent version because I sent you one when I was traveling, but probably it is. I mean, a lot of this is, of course, well known. New problems have been added to old problems, existing problems, gradual decline in productivity, big welfare states in combination with aging, etc. And I think now we also see, of course, the US tariffs, which gave us, we struck a trade deal, probably in exchange for security. We got, an unfavorable deal, but we also see then a lot of diversion of trade flows, etc., and power play by the US and also China. And I think rightly the EU is trying to, set up new trade relations, but of course this is going very slowly. Now, what we argue in our piece, which partly focuses on these European safe assets, but it's also a little bit broader, is that actually we need a combination of policies. And one is indeed a larger and reformed EU budget. I will say a few more words about this, but a budget that should focus on European public goods and less on traditional spending like regional common agricultural policy, etc. And a budget that allows the EU to issue more debt, also backed by own resources. That's quite important because as we show in this paper, but also other paper that we are working on, is actually, so the ESM has an advantage relative to the EU because it has paid in capital, and the EU just is based on promises of contributions. And to the extent that these expenditures on European public goods, I would see them mostly as investments. It makes sense to issue debt, to finance them, because you would then spread the cost over multiple cohorts. Now, Galen showed already that the sum of the supranational debt, which is generally very safe, is increasing. If we want to have an asset that really, outcompetes German bonds, I think we should. I mean, there's no other possibility than to have a bigger EU budget that is partly financed by debt that can be rolled over, etc., to have a deep market. Now, I was saying it is really the combination of policies, because there's also, of course, a savings and investment union, and it will work better when there is public investment at the EU level, and that makes the marginal product of private capital higher, and vice versa. But also we need more long-term risk-bearing capital. So aside from the safe asset, we need to have in Europe, we need to have more capital that is willing to take risks. Now, a few points. I was already mentioning the EU budget. In July, the Commission President made the first bid for the next MFF, and in real terms, it's hardly larger than the existing one. If you include the servicing of the NGEU debt, it's just a little bit larger. But I think a good thing is that it is more flexible, and so it has three main headings, which has a lot of flexibility within them. Although the European Parliament leaders, of course, they pushed back, and some of that has been lost. But in any case, the simplification and the increased flexibility are welcome. However, it is way too small, and its allocation is suboptimal. There's too much for traditional programs, and it seems almost like the new realities have not sunk in. There should be, priorities should shift to productivity, energy transition, but also security and defense. And these are long-term investments that can be backed by debt, EU debt, that could then, in the end, when it becomes large enough, it could be kind of the standard safe asset. I also want to say a few words on the importance of private capital, and I think Judith will go into that further. And that is, the US has funded pensions, or at least the funded pensions part is a big part. If you look at Europe, it's only in a couple of countries, Scandinavian countries, in the Netherlands, that have big funded pillars. But this, pension funding provides a huge opportunity to increase the supply of savings that is also willing to bear risk. And in some work that I did with Danish colleagues at the Copenhagen Business School, we actually looked at what is the effect of a pension fund investment, an equity stake in a firm. If the pension fund takes an equity stake in a firm, and we see these estimates that are done with registered data, you see that just following taking a stake in a firm, we see that is PFI. It's a dummy for the presence of a pension fund as an investor. You see that productivity increases by 3%, which is quite a large amount. If you look at if you do instead estimation with where you include the share that the pension fund takes into a firm, then for each percentage point stake you get an increase in productivity of about 0.2%. And an alternative estimation in which you just look at how long does the pension fund keep its stake in the firm, you find that the longer it keeps its stake, the larger is the productivity effect. And by the way, quite interestingly, we split these estimates in listed versus non-listed firms, and you see that on average you keep an effect of about 3.5 to 4%, but the effect is concentrated among the unlisted firms. And so it is really, and that's not surprising, because precisely those smaller firms, the startups, but also the bigger firms, they need this capital. And so we found that we think that there are potentially 4 effects. Pension funds provide long-term financing commitment. That is especially important when you make investments in new technologies, etc., increased supply of funding, but also engagement by professional experts, etc. And pension funding could provide positive signal to other investors. So I think there are huge opportunities by stimulating pension funding. This is something that pension funds are especially well placed to play this role because they have long-term liabilities. So they to balance to reduce mismatch risk, they would make long-term investments, and these are precisely the investments that are needed when you invest in new technologies, etc. Now, more generally, I mentioned that we think a combination of policies are needed, but of course it's very difficult politically to move on. I think the Dutch election result gives a little bit of hope that where apparently in the Netherlands people have got fed up with the empty promises of populists, and they are moving again towards the more mainstream parties. But I think if we want to move forward and also at some point have a bigger EU budget, then probably we need to think of policy packages in which some countries would, maybe the Netherlands would accept a bigger EU budget, but then in return it would also get further market integration in goods and services, but also in the capital markets. And otherwise, you would probably, second best would be to work with coalitions of the willing and to move forward in that way. Thank you.
Thank you very much. Thank you very much, Roel. And I think it was a perfect transition to Judith's intervention. Thank you so much.
Now it's working. Okay, thank you. So I'm going to tackle the private side of the equation, which I think is crucial. Of course, I understand that the public funding side of the things is very relevant, but also according to Draghi report, 80% of this investment gap that he was referring to needs to be covered by private funding. So how are we positioned to do this in the EU, in the euro area? So starting with this graph, basically we see that euro area households' wealth is heavily concentrated on real estate. Of course, there is heterogeneity across member states, but on average in the euro area, we see that almost 70% of households' assets are real estate assets. So basically, financial wealth is around 30%. Then again, if we have a look at financial wealth, we see that there is a lot of heterogeneity. But what we see is that on average, more than 30% of financial wealth, of financial assets in the euro area is composed of currency and deposits. So basically, we could call it non-productive investments. I understand how important deposits are for banks. They are a relevant funding source, but they are not as productive even for households and also for the economy as a whole. So, but here we also see that there are clear outliers. We see how the Netherlands, Denmark, and Sweden are way more exposed to other kinds of financial assets and way less exposed to currency and deposits. If we have a look at another metric, we also see again the heterogeneity. We see that in terms of the percentage of population with an investment product, there are member states such as Sweden, Luxembourg, Finland, and Denmark Denmark, so it is no coincidence that we are talking about the Scandinavian countries where the percentage of population with at least an investment product is way higher. And well, this takes me to a point that the European Commission has also been lately exploring, and where they have issued a recommendation, and it is how are financial literacy levels in the EU. And it is no coincidence that we see that member states such as the Netherlands, Denmark, and Finland have a percentage of population with higher levels of financial literacy. So basically, this takes me to a clear relationship. We see that there is a negative relation between the levels of financial literacy and the share of wealth held in cash and deposits, meaning that the lower the level of financial literacy, the higher the share of wealth held in cash and deposits. And this makes sense clearly if one doesn't understand the type of financial product they're exposed to. This calls for prudence, and they basically go to deposits and currency and cash, which are the safest possible options, but of course they don't yield any returns. So this is the retail side of the story. Now let's move to the wholesale side of the story. This is something that Roel has already touched upon. He indeed mentioned that most of pension systems in the EU are pay-as-you-go systems. And this is clearly shown in this graph. My own member state, I find this graph pretty scary. I'm Spanish, so if you have a look at the non-funded pension obligations as percentage of GDP, it's 500% of Spanish GDP, and it's still growing. However, as Roel was mentioning, we have there 3 member states, the Netherlands, Sweden, and Denmark, where we see that funded private obligations are way higher. Of course, this is very much linked to the development of capital markets in these member states, so it is no coincidence that capital markets in these member states are way more developed, and needless to say, this removes a lot of pressure, fiscal pressure, from public accounts. And another point I want to make also from the institutional investor side is that, and these data I'm showing are for investment funds, but they are very much the same for pension funds. So investment funds, pension funds in the EU are way more fragmented than in the US. So when it comes to investment funds, we see that the average fund size in the EU is 0.4 billion euros vis-a-vis 2.7 billion euros in the US. And of course, this means that the average cost for retail investors in terms of fees, for instance, is higher also in the EU. So we have financially illiterate people, and we have more costly investment funds and more costly pension funds. So with all this, basically, I think that the pieces of the puzzle are very clear as to in what direction we should be moving to trigger this private funding that we need for the digital transition, for the ecological transformation. First of all, we need to promote financial literacy. That's clear. The Commission in September came out with a financial literacy strategy for Europe. It's based on soft measures, of course, because this is not exclusive competence of the EU. The second point is to mobilize retail investments, and the Commission came out also at the end of September with a recommendation on savings and investments account based on 4 pillars. And really, Roel was talking before about the coalition of the willing. I very much support this idea, but we should be careful. And what I mean by this, before the European Commission came out with this savings and investment account recommendation in September, under the Competitiveness Lab, 7 member states came out with the Finance Europe label initiative. which was very similar to the savings and investment account blueprint, but it was not exactly the same. And the main difference was that under the Finance Europe label, there was what I call an amplification of the home bias, because in order to benefit from that Finance Europe label, a financial product would need to invest at least 70% of the assets in the EU. Those need to be EU equity or EU bonds, for instance, which is something that was not included in the savings and investment account blueprint by the Commission, and I think that for the good reasons, because many times retail investors already suffer from this home bias. So there's no need to incentivize this even further. So really, I don't think this was a good example of coalition of the willing. I think that it was basically counter-programming at the European Commission a couple of months ago with measures that do not fully match each other. Then when it comes to the development of institutional investors, well, I think that it was last week that the Commission came out with a very important package suggesting an amendment of IORP 2 directive, PEP regulation, a recommendation to member states, and also on a communication on the prudent person principle. I think these go in the right direction. So here I have introduced a small table comparing the current PEP with the new proposal by the Commission, and some of the hurdles that were identified are being lifted now. I think this makes a lot of sense, but I'm not so sure that this will be enough. To be clear, I think this will not be enough, because at the end of the day, the development of institutional investors of pension funds is a responsibility of member states. So the European Commission can do all its best in having a better IORP 2 directive to incentivize consolidation of occupational pension funds. We can improve the PEP, but ultimately, if member states are not willing to implement pension reforms to go down the road of what we've seen in the Netherlands, in Denmark, or in Sweden, this will simply be useless. And the final point I want to make is that we need less fragmented capital markets. We have a pending ESMA review. Let's see what comes out from here. And I also want to connect this very much with the banking union and also launch a message to member states. So it's not only for the Commission or the EU to, it's not only the responsibility of the Commission or of the EU, it's also the responsibility of member states. Many people tend to say that there is some kind of contradiction between the banking union and capital markets union, and that the banks don't want developed capital markets because it's not in their interest, because this would simply take away power from them. And I don't agree with it, and I personally think that a banking union is the first step towards a capital markets union, and let me explain why I think so. If we think about who channels these investment products, investment funds, pension funds, it's mostly banks in the EU. So if we have cross-border mergers, we can also think that managers, fund managers, and even pension funds, investment funds would merge and would become less fragmented and bigger. So I do think that there is a clear and a close relationship between a banking union and capital markets union. I'll leave it here. Thank you.
Oh, it should be working. Thank you very much, Judith. That was really informative. Roel, I saw you nodding a lot. Could you please comment on Judith's presentation?
Yeah, so I think, you know, this was, well, I was nodding because I fully agree. I think banking union and capital markets union need to go together. And on the first, there's still also a long way to go. If you see that, you know, some countries are blocking big banks from other countries to take over their own national champions. But I think that, how you say, in a way, banks should be, yeah, in a way, denationalized, so to say. So they should be able to operate without any boundaries everywhere. And of course, they channel savings towards funds. I think. And I, of course, also agree that when it comes to pension funding, it's national prerogative, and that is also what makes it so difficult. because it's politically very difficult to change the pension system, and it's become politically more difficult with the average age of the population going up. So I think there is a role somehow for the European Commission to try to promote pension funding, and I hope also that more capital market integration will promote pension funding, because it makes the trade-off between expected return and it allows for a better trade-off between risk and expected returns. And so I hope that will help in terms of promoting pension funding.
Thank you. Colleen, I'd like to ask you, how does all this translate into credibility for international capital markets? And also from your perspective, what makes Europe attractive to foreign investors as a source of safe assets? And if there are, can Europe become a trusted provider if progress is uneven across countries? Would that be a problem?
Yes, so I first, and there was a little bit the story that I had, I think we need to go big and we need to be ambitious. I think there was also a little bit of push that Adam gave to us, like, okay guys, now get your act together. And I think there's no better momentum than now for us to get our act together with this changing geopolitical world. So if I look at the international trust in Europe is still very big. I see that in capital markets. If you look at equity performance, Europe's equity this year outperformed the US. And I write it also in my pieces. If you look at the CAC 40 in France, the DAX in Germany, the Eurostoxx 600, all did better than the European.
Spanish did
also, yes.
Best. It's the best performance.
So that means that indeed international global investors are putting their money into European accounts, which I think is a big part of the credibility. But now I think we need to think bigger on the priorities in Capital Markets Union. I think we wrote that we believe there are 5 of them that we all need to focus on, which is supervision, safe asset, SME to IPOs, strategic finance, and securitization. If we get those done, we actually can have a very big, deep capital markets union. But also new themes, and I think that's where Adam, I think, came in, on topics like stablecoins. So the IMF meeting this year, there was one topic that came up in every of the 35 meetings we had. It was on stablecoins. And Europe is trying to find its way to where to position it. At the moment, there are around 300 billion in stablecoins, all backed by US Treasury because they buy bills. Projection is to go to 3 trillion, so 10 times more. What can we as Europeans do? So if you want to create, and we spoke to some of the European stablecoin providers, what can we do? Well, we don't have really bills, European bills that are as safe as the US ones. You can have a bit of German bills, but everyone wants to hold them. You have our ESM bills, they're great, but it's also not a lot. EU bills, and that pretty much is. So if we really want to create a European stablecoin, you need to have European bills. There is no other way around. Otherwise, you're dependent on US bills. You also mentioned digital currencies, or CDBC. In Europe, we're having this debate, should we have it or not? 2 weeks ago, I was in India. The digital rupee is working already 3 years. So if you go there on the market, you have a phone number of someone for 10 rupees selling you a banana, you can pay them with your digital wallet of the central bank. It's not that complicated that we need another 2-3 years in Europe to think about it. I think the Chinese representative left, but I was in Beijing in March, exactly the same thing, that the digital renminbi is working. Not everyone is using it because Alipay and WeChat Pay work much better, but it still is there and implemented. So I just don't get it why we need another 2-3 years in Europe to get our act together. And there are demonstrations in The Hague last week when I was in The Hague against the digital currency. I think we're here really a bit behind the curve. So yes, I think the international world looks at Europe still as the only remaining multipolar place geopolitically that you can work with. So when we're in China, they say we want to still work with you. In the US, people still want to work with us. So I think we can use that to our advantage. And I'll use one quote that this year, really from all this travel that I did to more than 100 investors around the globe. When we met with the president Tharman of Singapore, he said, if there's one continent of the three in the world, US, China, or Europe, that can bring the world together and bring peace, it's Europe. Let us take that as our guiding role, and also in capital markets.
This is very optimistic. And Judith, I wanted to ask you, does Europe's domestic investor base believe in that vision? Are European savers willing to hold more European assets?
So when I was mentioning the home bias issue before, is because I believe that we should allow investors to get the maximum return, or at least to find the optimal relationship between return and risk. So if EU investors are not investing in EU equity, I mean, let's just for a moment imagine that we solve the financial literacy problem, and that really EU households start investing in pension funds, in investment funds, even they go, they have their own savings and investment account, just like the Swedish ISK, which works very well. It's very simple. It has very simple tax treatment, even some fiscal incentives. We should not be telling EU investors you will only get this easy tax treatment and this tax incentive if you invest in what I'm telling you. No, go and invest there where you think that you're going to get the best return. And then we should think about how to make EU projects, EU-based projects, EU-based companies attractive and yield the return that will make EU citizens interested in that. And of course, I mean, this drives me to the Draghi report, which it talks about very high and about very broad and encompassing reforms. So I don't think that it's by forcing and by directing with tax incentives EU citizens into one direction that we will make the EU a more competitive jurisdiction. And then there's another point that it comes from the Letta report, and that I think that this has led to many misunderstandings, and it is this figure of 300 billion euros of household savings leaving the EU every year, mostly to the US. Okay, maybe I'm missing something, but if you have a look at the balance of payments, this is just the result of having a current account surplus. If you have current account surplus, of course, you are going to provide savings to the rest of the world. So if we want to keep savings and those savings to be invested domestically, then we need to forget about a current account surplus. And especially this current account surplus, to me, it's to some degree imbalanced. If we have a look at the composition between the private and the public sector, we see how the EU has public deficits. So this basically means that this current account surplus falls on the back of the private sector, meaning excess savings, lack of investment. So this is just pure accounting, and we need to change the narrative, I think. Thank you.
Well, I think you wanted to comment to that.
Yeah, because it is of course true that the counterpart of the current account surplus is just the capital movement, but there's also a lot on the composition of our savings, and I think here probably a lot is going wrong. You know, and maybe it's also because of governments running deficits and so putting debt in the market, and of course someone has to hold this debt, which is to a large extent also held by pension funds, insurance companies. And well, I think Europe really needs capital that is, you know, willing to take risks in order to finance, you know, new technologies and to finance growth. Of course, I think there's also, we need to think about how we regulate those big investors, insurance companies and pension funds, because insurance companies have to meet their liabilities with a very high degree of certainty, which means that they are kind of forced into you know, a lot of putting their capital in safe assets, but also pension funds. And I think regulators are always very concerned with the stability of individual institutions rather than with the stability of the entire system. And I think in terms of regulation, we need to think about how to balance the quest for safety of individual institutions versus what is needed at the macroeconomic level.
I would now like to open the floor for your questions, and I saw there was a lady in the back. Would you like to take my mic?
Thank you. I have a question for Kalin. You mentioned that there is an increased interest in EU assets. I hear this quite often now, but I've been looking at the data, at the macroeconomic data, and actually I cannot find strong evidence of this. Maybe it's not yet there. And actually I wanted to relate this to basically the announcement of the 2nd of April and whether that there has been a shift in preferences of investors from the United States to Europe and euro-denominated assets. And basically, also to explain the exchange rate movement, which is quite counterintuitive in this context. And basically, what we see is that actually investors are still investing in US assets, in treasuries. There has not been a reversal. But there is a lot of speaking about needs of diversification into euro-denominated assets. And basically, one thing came out, which for me it was quite a surprise, is that basically investors are actually hedging. There is something that usually foreign investors into the US do not do, is to hedge against the dollar assets, because it's considered completely safe. Now this has changed, so they started to hedge. And this is probably one of the main drivers of the exchange rate movement, so the depreciation of the dollar, and maybe the appreciation of the euro, because maybe some pension funds or investment funds were actually those hedging. Now, I wonder whether the one or the counterpart is actually an inflow of investment into the EU, or what we are observing in terms of good performance in European markets is actually comes from the inside. And distinguishing these two dynamics, I think it's quite interesting and important. I wanted to know whether you have any insights on this.
Thank you. No, I think it's an excellent question. And let me start big and then go small. So if you start big, if you look over the long term, the dollar is decreasing. So the IMF report on global currency holdings by reserve managers so these are the central banks around the globe. In 2000, 74% of the assets were in dollars. It's now down to 57%. So it is going down. It's not super fast, but it is going down. The euro was very high before the euro crisis, then went a little bit down, and now it's again up at around 21%. So it is still quite strong, but in the second, but it's not as big as the dollar, but it's increasing. Now, what is really interesting is if you start going into more monthly data since the beginning of this year, and if you start looking at reserve managers. So one of them, and I see this Chinese representative is back, so SAFE, the PBOC, is publishing quite transparently how much they hold in different currencies. So they are the ones that have a little bit switched out of the dollar, and you maybe can confirm it's in their data, and switched a bit into euro and other currencies, also diversified. And we see other central banks doing exactly the same thing, where they are trying to diversify a little bit away only from the dollar, and especially from the treasury. Now, the devil starts then being in the details. So we issue in euros and dollars. When we did our dollar issuance this year, we had the biggest book we ever had. And we got investors from Honduras, from Colombia, Cambodia, and all those places. And if you ask them, well, they say, well, we want to keep some dollars because of business purposes, and that's where we trade in, but we don't want to face US credit. So then they buy other credits that are still US dollar denominated, but it's bonds of the nations or of other institutions, which is, I think, a micro shift, which is interesting because they look at the fiscal policy of the US, and that doesn't look very appropriate in the long term from a financial stability point of view. A second aspect that we see is that there is a huge, and that was a blog we wrote, and then the ECB came out in June with their role of the Euro report. It's the year with the largest amount of issuance in Europe by non-European countries. So it crossed 1 trillion. This is what we wrote in our book. In our blog. So countries like China, Saudi Arabia, Indonesia, Chile all started issuing in euros in order to diversify a little bit their investors globally. I mentioned I was 2 weeks ago in Saudi Arabia, and I asked them, the Ministry of Finance and the Public Investment Fund, why do you issue now euros? You didn't do that in the past. You started doing this more and more. One is diversification. 2 is lower interest rate, because if you issue in dollar, you pay 4 or 5%, in euro 2%. Well, that's great in servicing cost. But 3, you get a far bigger investor base, including the pension funds that start investing in these products. And then Europe has some niches where it's really good at green and sustainable finance. Even though we don't talk about it, more than 50% of this debt is in that area. So it will not be a dramatic change, but I think it is an evolving change that is happening. And I think if we look in the next 10 to 15 years, I think you will have a more multipolar world than we have today and than we had 20 years ago.
Thank you.
My name is Marie Cormont and I work for the civil society here in Belgium. And I have a question on financial literacy, so to the third speaker. So we are very pleased that financial literacy is acknowledged to be crucial by the European Commission. But we wonder who will be responsible for defining the contents of the courses, of the curricula. We know that commercial banks will be involved and also central banks, but we would be very pleased if civil society was given a role in this area. And then I also have a question on the European financial mechanism. I understand that there is some priority in line with EU objectives in terms of promoting, for instance, green economy. But is there also a way of promoting European values by selecting those who buy the EU assets? Or is it only market-driven, and as long as you can pay for these assets, you get them, given that the main criterion, as was highlighted by the third speaker, is return? Thank you.
Thank you. Maybe I can start with financial literacy. I'm afraid that this is, I mean, with all the differences that it has, but competence-wise, this is very close to pension funds. This is, again, the prerogative of member states. So, I mean, I can talk to you about what's happening in my home country. In Spain, we've been having financial literacy initiatives for many, many years. Initially, it was done separately, one by the Bank of Spain, our Securities and Exchange Commission, the Ministry of Economy, the Ministry of Education. Then they came together, they put on the table a proposal, but the truth is that, for instance, in Spain, this is not a part of a school curricula yet. So to the extent, in my view, that children don't start by understanding what the difference between, or the relationship between risk and return is, and how important some financial decisions for the future lives are, and that the deposits are probably not the best yielding instruments. I mean, these kind of very basic elements, they are not part of school curricula. So I don't know about other member states, but the problem is that these this very much depends on each member state, and I fully agree with you that civil society should be involved, because it's the only way of making sure that indeed we find the key to making people more financially literate. And another side of the story is also the lack of trust on financial advisors, and this is also part of this Eurobarometer. So it's not only that people are not financially literate, which is a problem. It's also that they do not trust on many occasions the financial advice provider by financial advisors. So basically we are left with a doom loop. So maybe thinking also about tackling this other element about how to make or increase the perception that financial advisors should be more trustworthy, I don't know, with further regulation or with more supervision. I think that it would also be important. But as I say, at least when it comes to financial literacy, it's a member state prerogative. So it very much depends on each member state.
I think it's an excellent question, especially when it comes from civil society. And the current commissioner, Maria-Louise Albuquerque, that is in charge of that 5 years ago, was also part of that high-level group on capital markets union. She was leading the retail pillar. And it's great that she now tries to bring the savings and investment union more in how do you get retailers or citizens to invest more. If you look at her communication in March, she, for example, included that we need to have cross-border European investment products. So that what you see is Dutch investors like to invest on the Dutch stock exchange, but would not that easily buy UniCredit shares. Well, it's one of the most performing banks at the moment in Europe, therefore it's on this big investment spree. So I want to, before I make my point, just do a little test with the audience. How many of you invests? How many of you invest in debt products, in bonds? How many of you hold government bonds? How many of you hold European bonds? Two. And that is a little bit, I think, one of the points. So if you ask this question in the US, how many holds a US Treasury bill or bond? Pretty much everyone would raise their hand. If you look at how many Europeans actually hold EU, EIB, ESM, or EFSM bonds, it's almost zero, like 2. So let's say it's more than your bank deposit, I can tell you. Yeah. Diversification is the game in town, but yes, the interest rate of 2-3% is still better than a deposit return. But the point that Maria-Louise Albuquerque wants to make is you need to make it easier to buy these European bonds. And in her communication in March, she said, well, we need to make all the EU labeled bonds, including my own, accessible to every European citizen, which is not the case anymore. So at the moment, if you want to buy Europe, you cannot buy Europe. It barely is done. You need to go through a lot of loopholes through your investment manager to find an EFSF, ESM, or an EU bond. And I think that is a bit the direction. Now, if you want to make investments, I agree with you, you need to do equity, but not only equity. If you want to diversify portfolio, you need to have at least 50% also in debt products, and that's why it's one of the biggest markets. But I think for civil society, we need to make it more accessible to the cross-border investments, so indeed the Dutch investing in Italian companies, but also to make the European debt products much easier for a citizen to invest, and just go on your app and buy an EU bond. I think that will make mentally also a big game changer to support the European Union.
Just very briefly on financial literacy, because there is a huge literature, I think, that goes into this, for example, Luz Hardy and those people. But I think no amount of courses on, financial stuff will actually bring financial literacy up to a level that you can completely trust everything to people to do. And, so I think when it comes to, for example, pensions, like in the UK, auto-enrollment, those type of, or default, portfolios are very important, because most people, even highly educated people, they don't know what are the best choices to make given their preferences.
I saw some raised hands before. Yes, Jiffer.
Hi, my name is Roland Verstappen from Fleischmann Hillert. We have many clients who are, involved in US, China, and Europe. So I haven't heard anything about artificial intelligence. And I heard a panel say that Europe is still more attractive for investments. Didn't specify, for what kind of industries, which of course we can do. But when you look at AI, I mean, clearly those investments are all going to the US and China. And we are very much behind in Europe. And I know that there are software companies in the US who have already developed AI software models that have been incorporated into industrial companies that make them more efficient. Things that they could do in 1 day before, and 30 days before, they can now do in 1 day. So those things are happening as we speak. We're not going to talk about the energy and the data centers, which is also happening outside of Europe. So all these investments are going to the US and China. So and that is the revolution which is going on, if you believe the experts, because American companies who have this technology will become more efficient, which means their products will become cheaper, their margins will still be good, then they will sell into Europe, and our companies won't have that. Is that real, or am I exaggerating this? And is it therefore not true to say that the investment world is more and more going to the US and China, who are competing, of course, to be the #1?
Is that real? Is there a bubble?
No, thank you so much. I can give it a first try. It's a very interesting and broad question. So I would make a difference, and I think that's also part of your reflection, between being at the forefront in emerging technologies and incorporating those technologies into your daily processes, which is where I think that the key to productivity really lies. So of course, it would be great if the EU was at the forefront of emerging technologies. If we have a look, for instance, at the technology tracker, which I recommend very much by ASPI, which is the Australian Strategic Policy Institute, we can see there how in the main emerging economies, it's either China or the US at the forefront. There's no a single EU member state. Of course, that's not ideal, but what really worries me is that our companies don't have the incentives or don't have the talented management to realize how important it is to incorporate those technological advancements into their daily operations, which is where I think that total factor productivity gains lie, basically. So I wouldn't be so worried about not having investment in taking these frontier technologies forward, which of course it's worrying, but I am more concerned about the second side of the story.
Yes, so I think it's an excellent question. And I mentioned the equity outperformance of Europe versus the US. It's in my slides of 2 weeks ago. You can find them on our website. I show if you take out of the Nasdaq the Magnificent Seven, so NVIDIA, Alphabet, etc., they by far outperform. The rest of the US stocks actually doing terrible, but those do extremely well. So there, indeed, the US especially has an edge. China also with DeepSeek, but also if you look at their innovation in EVs, so electric vehicles, etc., they're far advanced. Where I'm a little bit worried on AI is, and I'm writing this in my blog for next year, it will be out in 2 weeks' time, roughly. I'm looking at Juliana from my team. I do mention AI as a potential risk in the sense that I think it is at the hype cycle stop. So I'm a bit afraid that we're now in a 2001 model where you might actually get a contraction. And why do I say that? The productivity, macroeconomic productivity gains are not there anymore. So I think we all are using AI when we plan our holidays. Instead of using Google, we use ChatGPT, etc. But the macroeconomic productivity gains in companies and in countries have not yet materialized. I use on purpose yet. It might happen in a few years. But I think we are now getting a bit to the end of what we can do in this short circle. So I think these valuations are a little bit on the high side. So I think there will be some sort of a correction happening. And I think in Europe, we need to do 2 things. One is we do need to invest more in AI and innovation, absolutely, and more cross-border innovation, but also ensure that we don't get into this risk that an overblown market can create. So, because if it blows up in the US, it will hit Europe. We saw that in 2001. We saw that also in 2007. So I think we need to look at financial stability risks that it can go with it. So that's a little bit my few soundbites on AI.
Yeah, I think the biggest part, and here I concur with Judith and Kalen, is actually the adoption of AI, and the biggest part of economies are, small and medium-sized enterprises, and I'm sure that, I mean, in Europe they have difficulty using AI in the processes, but I'm sure this is also the case in the US, and I think it also has been documented. So it will take time for AI to be applied in companies, but I see that happen, and we actually have a lab at our faculty where we do it now, a pilot with our so-called AI for Business lab. You can find it on our website. And it's a pilot with small, medium-sized enterprises in which we do a pilot and see how they can, use AI in their business.
Okay, I will allow myself to steal 5 minutes of your coffee break. I hope you will forgive me. We had a question here from Andrew. And
thanks. Quickly, yeah.
Coffee break.
Thanks, Ekaterina. So thanks very much.
I think the mic is not necessarily on.
Oh, hello. Speak more loudly.
Much better.
So, I'm Andrew Watt from the European Trade Union Institute. Lots of very interesting points on public finance, but I'd like to focus a bit on private investment. And it's not just you, Judith, in your presentation here today, but one hears this often in Brussels, this idea that the structure of household savings and whether the pension systems are pay-as-you-go or capital backed pension systems is somehow decisive for private investment. And I wonder always a little bit about the sort of evidence base for this. And without doing a sort of econometric exercise here, I mean, if one thinks of countries like Germany or Austria, right, which have sort of famously conservative savings behavior on the part of households, bank-based systems, no great role for capital markets in their pension systems, yet somehow investment's weak in Germany at the moment, but over the years, these countries have invested very successfully and are sort of more or less on a par with the Netherlands or the Nordic countries that you mentioned. So I wonder where the evidence is for this assertion, which, and I mean, you made it this presentation today, but it's something one hears often in Brussels. So thank you.
So I hear where you're coming from. I think that one of the main challenges of the EU economy right now is that we live still, I think, in the 20th century. So meaning, for instance, thinking about the German economy, a bet was made for hardware industries, for traditional industries, and we can see this in the automotive industry with internal combustion engine cars, and this compares very much, for instance, to what we're seeing in China with electric vehicles, which are pure software. So the issue is our financial structure adapted to the challenges that we have in front of us, and is it good enough to fund innovation? Because if I think, for instance, about real innovation that can happen in a startup, really having a bank-based financial model is not what will allow these innovations to happen, basically because startups don't have collateral. And if you go and seek funding in a bank, they're going to ask collateral in exchange for that. You will have to have some kind of real estate or personal guarantees, and that's not what the most innovative businesses currently have. So we see how many times we lose startups or even scale-ups, and they leave to the US simply because they have some other sorts of available funding sources. So I do think that's why these kind of funding sources are so relevant. And another very relevant thing, but I didn't bring the data with me because if not, it would have been a 1-hour presentation, is also to have a look at what the pension funds are currently invested in, because we tend to think that pension funds, they are going to invest in equity, and this is going to bring in more innovation, and we're going to bring to the table some kind of different investments. And depending on the member state we're talking about, and EIOPA has available data about this is not necessarily the case. So we see some member states where pension funds are heavily invested in public debt or heavily invested in simply bonds, but not so much in equity. So it also depends on member states. That's why I was insisting so much that this is not so much an EU issue, but more a member state issue. I don't know if I answered your question.
If you don't have anything to add, I would suggest that we don't go further over time and just take this discussion to the coffee room and enjoy a coffee break and come back at 1:45 for the second session. Yes. Thank you so much.
It's really low. Need to talk.
So welcome back, everyone. Can I invite you to sit, please? Yes, wherever you want, whatever you prefer. Okay. Welcome back, everyone. And we are now going back somewhat to the beginning of this conference. And I really want to start again with a global perspective, and then going into the implications for the EU. I'm really pleased to have such a good lineup of speakers with me. Let me introduce them. So Daniel Gross, just to my left, is the director of the Institute for European Policy Making at Bocconi University in Milan, former director of CEPS. Daniel, welcome back. And then next to him, Maria De Mersis. She is the leader at Economy Strategy Finance Center at the conference board. She's also professor at the EUI and former deputy director of Bruegel. And then Erik Fossing-Niels is now associated independent economics, former chief economist at UniCredit. So welcome everyone. So for this session, which I think has a very broad topic, I thought actually to have somehow three parts. So the first thing, I want to go back to the global assessment and where we stand with all these major shifts that are happening, in particular with the changes introduced, transformations, I would say, introduced by this new US administration. Second point, what are the direct implications for the EU? And third, I want to speak about policies. Okay, so first question, and I want to start with Erik. Some of you may know that Erik publishes a blog. I think I can go blog. It's a blog on Substack, and is called the Sunday Wrap. So it's something I really recommend to you. And a few weeks ago, if I read you correctly, you pointed out that some of the changes that we have been observing since, let's say, April 2025 are actually not so new. And maybe we didn't read properly some of the changes which have been happening for some years, especially in the United States. I think it's quite in line with what Adam Posen said at the beginning. Would you like to explain why we are in this situation, or how you came with this assessment?
Sure, and thank you for having me. So my key point is that nothing happens overnight of these big things. I mean, it's sometimes these are big moves, waves in society over time, and sometimes, of course, there's a leap forward or backwards, or you want to put it, something happens and it becomes a little bit more dramatic, and this is what we're having now. So, just to elaborate a little bit on what Alan also said, the way I think about it is, and this is, I think, for everybody in this room, all we really can remember from before were these wonderful years of globalization. and they were amazing, right? I mean, like, I date them back in some ways to basically 1980. You had the Reagan-Thatcher reforms, liberalization. Not all of that was good, but it made a big push. It was also 1980 that Solidarity was established with the first strikes in Poland, right? Where the transition began. And then, of course, 1989, the big change. And then we have that period. That's also where the transformation in China happened. We had these economic transformation. We had these big moves, and we had fantastic years where growth and real income around the world did very, very well. Particularly in emerging markets. China is the example we got. We lifted more people out of China, lifted more people out of poverty than we've ever seen in the world before. And in here in Europe and America, those who were lucky enough to be at the top X% also benefited. There's this famous elephant chart, right, that shows there was somebody in between, which actually probably is part of what now led to Trump. Right? I think it started to turn with the great financial crisis in 2008. Actually, you could say it started the year before when Putin showed up in Munich and said, actually, you got it all wrong. America is a big pest in the world. Right? You remember the famous, and everybody said, what did he mean with this type of thing? And then it sort of slowly started to unravel. We had in, I forget what year it was, he invaded Georgia, right? And in 2014 it was 2008, 9 or something. Then you had 2014 Crimea, and then finally in 22 all of Ukraine, right? So we had these sort of big moves that slowly, and I, as an analyst, I wish I had certainly had paid more attention to. I saw it as, not so good here and there, but the thing that also happened, I mean, on the economic sphere in 2008 with the great financial crisis, I think, and our Chinese guest or attendant can maybe confirm or dispute this, I think that became the year or the event where self-confidence, and rightly so, in China and its policies lifted dramatically. I mean, in 2009 and 10 or thereabout, China provided something, I forget the number, 70 to 80% of all incremental global growth. Right? As the West were on our knees because of the great financial crisis, because the Thatcher years and Reagan years, and the finance industry got it wrong, and then we got the collapse. So suddenly there were a lot of question marks in Europe and in America about our model, and the Chinese model looked good, right? And they provided the growth. So I think there was these big changes. And then very quickly, I'll just say what happened now was sort of the accumulated pains of this. The financial sector had gone overboard, had created too many dangers in society, and we got the collapse. We had the benefits of globalization had not benefited enough of people in the democratic world. Right? So we got Trump in first instance, and now we got him in the second instance, if you will. So what we have now is the accumulated effect of the Putin took more and more for reasons we can talk about. I'm not sure I know all of it. But for me, at least, I think for most people, 2022 and the full-scale invasion of Ukraine really said, this has changed now. We have on our eastern border major dangers. And it was a wake-up call because, and we talked about it before, for us Europeans, wake-up call, my God, China is on their side or neutral, depending on how you define it. And not only China, India, Brazil, Vietnam, South Africa. When there were votes in the UN on it, they were sitting on the sideline. They were neutral. And we suddenly realized we were not the center of the universe anymore. My God, everybody did. We had an opinion that this country just invaded another country. Big wake-up call. Big wake-up call. And then came Trump 1, and we can talk about this separately, but Trump 2 is fundamentally has changed the game. We now return on his allies, but more importantly, he has attacked the institutions of the democracy of the United States. Right? This is, last thing I would say, when Adam Posen talked about the dollar credit lines, could you imagine that one day we need a credit line and he says, yeah, but being Danish, if the Danish central bank called the Fed and said, can we get a dollar credit line? And it's the next Fed president, he calls over to the White House, I can quite imagine what Trump is going to say. Yeah, give them the credit line, but I want Greenland. Yeah. I mean, this is, the world has completely changed now. And I don't think there is a real way back. I mean, so.
Okay, thank you for this tour and this open, but I think it's a good way to start. Let me move now to Daniel. So let's focus maybe a bit more on the economics. I know that you have a bit of a view, a strong view, say, when it comes to trade and the impacts of the US tariff and the extent to what they matter, or actually they do not matter, and the fact that maybe we really need to look at China rather than at the United States. But maybe you can explain this in a more elaborate way.
Yeah, thanks. It's always good to be back. Let me say, as a beginning response to Eric, in my view, the importance of trade and globalization for the shifts in income distribution and sectoral shifts has been vastly overstated. And I think that is partially the fault of our policymakers who have exaggerated the benefits of globalization. Everybody can trade everywhere and everybody will benefit. And I think we are seeing now an illustration in the US that actually the damage is limited. Right? So I think there was some exaggeration. But let me come now more specifically to US trade policy and the impact on Europe. I would say the impact on Europe is broadly neutral. Actually, I would see even more opportunities than dangers. And the prevalent narrative is just fixated on do the United States impose tariffs on us, yes or no? Of course, we are worse off if they impose tariffs. But if you look at the entire package, the deal is very different. The entire package that Trump is offering to the world is basically 10 to 15% for everybody and 45% for China. And that's a package that's not so bad for us. We are the US is a major export market. The Chinese are our biggest competitors. So that means that in the biggest market, we are protected from our biggest competitor. Right? So that's not what's so bad about that. And the Chinese market is not so important for us, but in the Chinese market, we also have some advantage, right? The Chinese are not as crazy as Americans in terms of tariffs, but I think Boeing now has to face some more questions than Airbus in terms of reliability and political interference. So that actually is something that comes out from any economic model you want to use, a global model, right? Not a bilateral one. If two countries start a trade war among themselves, the rest of the world is bound to benefit. Right? Now, how do we benefit? And that is, I think, where the political economy danger comes in. Because the way, if you look at the models, we benefit is that the exporters, right, and the US is not such a big exporter, but China is a big exporter, they have to lower their prices in other countries because their market has shrunk. Right? So that's the famous flood of cheap Chinese imports. Right? But that is just the bilateral view, us and China. If you look overall, we still have a large current account surplus, and the cheaper Chinese exports should be welcome because they will liberate resources to have more expensive exports to the rest of the world. Just the other corollary of any model-based, also common sense, is our exporters can increase their prices relative to the pre-Trump situation in the US and in China. So, and that offsets, if you want the quote-unquote losses from the higher imports that we have. So, and that is, I think, the danger I see. In Europe, people are fixated on the bilateral trade balance and more Chinese goods coming to us. The policymakers don't see the much more diffuse export opportunities that arise, and the fact that in any sensible model that should at least compensate for this famous flood of Chinese imports. So I think one has to be very careful when one looks at Trumpian policy. In the end, it is basically the United States that is shooting itself in the foot, and try to shoot the Chinese in their foot, right? But that's not a business we have to participate in. We should just carry on. People have talked about Europe didn't respond to the Trump tariff deal, right? Why should we respond with doing our own stuff, right? I think you have written in the past about the threats and complicated game theoretic considerations, right? Very nice paper. But I think with Trump, right, if he has 15% of everybody, which I think Adam said he needs for fiscal reasons, let him do it. I don't think we can deter him from that. If you want, I can add something about the importance of, I think, Europe for the global trading system, based on the 1930 experience. It's not the first time that the US has suddenly increased tariffs without any reason. They did that already in the 1930s. Among economists, Smoot Hawley is infamous. And what happened was that in the first instance, the countries subject to it, they retaliated against the US, right, which was already, I think, bad for them. But then the really crunch came when the United Kingdom said, okay, now we get this flood of cheap imports from the Europeans who can no longer export to the United States. And we have to protect our market against that. And then, of course, it became a free-for-all. Everybody had tariff against everybody. And then global trade as a percent of GDP also, not just absolute, tanked. So I think the key thing is, if we let Trump do it, let him do his business. If we do not start to also put tariffs against China and anybody else, then I think world trade can continue more or less as before. 15% of world trade, that's the US, is subject to, let's say, 15, 20% tariffs. The rest of the world carries on as usual. And in that case, I think the costs are 90% for the US. If we start doing trade wars among ourselves, all hell breaks loose.
Okay, so we had quite two different views. So Daniel remains more optimistic for global trade and for Europe. Maria, maybe your thoughts on what kind of changes we are in, and feel free to react also to, to what has been said.
In terms of the structures, if I may, okay?
Is it speaking?
So, in the interest of not repeating myself, repeating some of the interesting things that were happening, and maybe I just comment on a few things. I too was extremely kind of the wake-up call for this. In Brussels, we received wake-up calls every other day, so we have to be careful how often we use that expression. But the one striking, I think, experience was seeing the first vote in the United Nations when everybody, when it was, you know, we came in thinking this is the unjust war. And the votes that came out of that were a very different, gave a very different picture of this, of where the alliances were. So I think that is one big structural change. And you know what caused that is, of course, a big chapter to discuss. But I think, you know, the extent that you think that there's a dominant, let's call it the Western model, for lack of a better word, that was actually dead on that day, I think. But there are other big movements, if I may call it tectonic movements, that are important. And of course, China is important here. China is a long-haul country, comes from very far back, has a very.
Sorry, I think the mic is not on. Can you push?
It's not on. How about now? Oh no, now it is on. Yeah. Yeah, I mean, I think then China, of course, is important here, right? And China is a country that has what I would call a different business model. Yeah, the business model that it has is quite different. And one interesting thing about, it's always surprising, but it's very interesting to see is how the flexibility that this economy has, certainly by comparison to the standards of our economies. We're about to publish a little piece in which we show the European Union imposed tariffs on electric vehicles in China, guided by the experience on the solar panels. We imposed, as European Union, we imposed tariffs on electric vehicles. And actually here, about a year afterwards, so we are now a year after these tariffs came into place, you actually see that the value of electric vehicles that is coming from China was like this. And as soon as the tariff imposed, it went like this, yeah? So, you know, we declare victory. But actually, if you observe the volume of cars that are coming into the EU from China, electric vehicles in a broader sense, not just battery-generated vehicles, you actually see that has continued in the same path. Meaning that, and now we are speculating, the Chinese economy itself as an economy did two things: absorbed the tariff cost and diverted certain electric vehicles for other electric vehicles that were not under the tariff regime. And that happened overnight, so that within 1 year, you actually see that the exports into the EU in volumes, in kilograms, which is how it's measured, has actually remained at the same path that it was before. That's an incredible amount of flexibility, which, you know, we wouldn't be able to do it in the current business model that we are and you have to ask yourself, what does this mean? And I think the big elephant in the room here, and that is not just about China, but it's also about the US, is dependencies. And I made this question to Adam earlier on, but I really think that dependencies is where the real game begins in an environment that is extremely uncooperative, where increasingly the rationale is a zero-sum game. Dependencies really matter. We saw the Nexperia event just a few weeks ago in the Netherlands with the Chinese. Nexperia is originally a Dutch firm that now it was bought over by the Chinese. The Dutch used an unprecedented law to take control of the company on the governance side because of reason. They had good reasons for this. The International Criminal Court in the US has moved away from using Microsoft email into some obscure Swiss provider because of sanctions that the US government imposed. The 2025 is a year that will be remembered where everything got weaponized, everything. Adam talked about medicine, that the dependencies of China. If you now look in Europe, dependencies on defense, dependencies on critical raw materials, dependencies on digital, from the cloud all the way down to email, and then finally finance. Where is Europe here? I think and broadly, I think the one thing that we need to also refer to is the two big tendencies. The one is the green and energy transition. And how that will be fought globally with pockets of wars emerging in the world. Think of Venezuela, think of oil, think of Sudan, gold. The global south more in general as a contributor to the green and to the green transition. These are events that were not with us 10 years ago. They should have been, but they weren't with us. And there are now confrontational attitudes. And of course AI, we need to go back to AI because there are huge movements there. So no, we're not going back to where we were. The challenges are very different to where we are today, and the question is what are we going to do about it?
Thank you very much to the three of you, so quite three different views. Now, let's try to unpack a bit how these challenges actually are impacting Europe. And here, I just want to link back to what Maria said. We are really in a world where interdependencies, which were seen as a big asset and the center of globalization, now have turned into vulnerabilities. So a complete change of narrative. And basically, we are in a world where considerations about securities basically override the principle of optimization. And this, I think, maybe we'll discuss this at the end, applies both to businesses and to policy. But let's try not to move on what are the impacts. I would like to go back to Eric. So given all these broad changes, where do you see the main challenges for Europe? In the end, we have a very long list and we will have to make some priorities. So it's more external, so like more security. It's more internal, like fragmentations and the fact that we have productivity issues. So where would you put actually?
So let me start by saying a friend of mine who was an advisor to President Clinton, who is still sitting around in Washington, said to me not too long ago that the way you want to think about it during the Biden period is that when meaning President Clinton, were in power, when there was a council around the president, the Treasury Secretary spoke first, and then some trade maybe, and then security. Today, under Biden, it's Luke Sullivan, the security advisor, who speaks first, and Janet Yellen, economics, afterwards. So, and that tells exactly what you, Maria, said. It's like, this has completely changed, right? And it is, and because do you remember Tom Friedman from the New York Times? He coined this phrase that the golden arch. And the point was, two countries that both had McDonald's, it's the golden arch, has never been to war with each other. Right? So if we all adopt free trade, investment, we all love each other, we all understand that the benefits of trade and economics is so good, then there's no need to go to war anymore. And therefore, we got the peace dividend and all the rest of it. So this is, I think, it's really important. And before I come to your specific question, if I understand you right, Daniel, I disagree with the way you described the trade story. It sounded to me as if when you said if two countries go to war, trade war with each other, it's good for the rest. that sounds like you think of trade as a zero-sum game, which I'm sure you don't. No, I'm sure he doesn't. You can see that. But it's always sound like. So when Trump does what he does, that's bad for America, but it's also bad for the world, right? It is. So I think it's really important. And trade, I think, was really important. As I should have said it before, in the golden years, as I call it, the globalization, trade to GDP doubled to about 100%. And that peaked in 2008 or 9 or thereabout. And then it went flat, and then it gone down a little bit. Not a lot, but a little bit down. So this has fundamentally changed. To your question. To your question. I think, as we talked about it a little bit outside at coffee, Europe is still in a state of shock for being basically betrayed by a parent, the US. We thought they gave us the security and everything else, and suddenly, and this is not like Adam said, betrayal of a sibling or a spouse, because that you tend to get over, I think, I'm told. I'm not tried. Anyway, but betrayal by a parent is fundamental, and it's really fundamental. So we don't know what to do. But as an economy, first good and then not so good news. The good news is Europe is still a mighty economy, right? So when we are saying again and again we are scared of the Russians or whatever, I mean, let's just get a reality check. We have a GDP that is 10 times bigger. And warfare is not just tanks anymore, right? It's like we have 10 times more and we have 5 times more people or something to that order of magnitude. We can't be, I mean, I know he has nuclear weapons, but the Chinese has kindly said that he's not allowed to use them. So I think let's keep this in reality in it's like, but the world is changing, and as you both said, security and economics has started to, it's become all one, right? So now it becomes very, very difficult. I think our biggest problem is the internal divisions. And by that, I mean not only between member states, but also in society, where we have far-right parties which have been funded by Putin and Trump and others type of thing, and messing around. There was another famous Munich security speech, namely by J.D. Vance, right? I mean, this is stunning, right, for Europeans to listen to, right? So we have to figure out how to deal with this, right? And we can talk about in the next session. So we have these internal divisions. I think the answer to Europe is indeed that we need more coalitions of the willing. I think, if I may put it very bluntly here in Brussels, is that Europe has become too wide, broad enlargement to be deep enough. You can't have Germany, France, Italy, Spain, or whatever, depending on Orban. It just can't work then, right? So we have to get more, and the ESM may be a good model of doing how you do intergovernmental things. It's not first best for a European, but I think this is the way we will have to deal with. And it comes back to the issue of getting part of we talk about capital markets union, but and incentives for risk taking and all the rest of it. Security matters. Basically, I think, as Adam said, the things that so clearly common: security, environment, and energy, exactly, ought to be done collectively, and then move on from there. But
thank you. Back to Daniel. So basically, one of the main points until now is this idea of economic security, and this as a principle, basically guiding decision, somehow means that this idea of free market or optimal allocation of resources based on efficiency is really challenged. I know you started in Chicago. We had many discussions. Daniel is a strong believer of markets. How do you reconcile, if it's possible, to reconcile these views with this view with the reality?
I think you have to reconcile that view with reality. And there I'm totally with Adam. There are, let's say, some very circumscribed sectors where you could say there are some let's say actual national security issues. but I would say in the broader economy, if we start to put security first, it's such a nebulous concept, and it's captured immediately by special interest groups or by the incumbents, right? If you, there were some meetings also of industry representatives in Germany, they said, okay, now we have to put national security. And then everybody says, oh, my industry is essential, right? So, and that is, I think, the danger. If we, and I think that is what leads to, let's say, less efficient policy making in the US when you say, let's have the security people speaking first. Because in my view, very often they're very poor judges of what is actually strategic, what is substitutable, and what is not substitutable. And therefore, I would say, yes, keep, let's say, these very circumscribed sectors. There we can have some security-related policy measures, but all the rest, I would say, if the others do it, we don't imitate them. And I think that's the key. I could give you a number of examples of where this security obsession, in my view, is completely misplaced. If I can say about, for example, this famous rare earth story, right? Now, if you look at the actual trade, the actual imports of the United States, let's say, in rare earth, which are traded in two ways, metals and compounds, the total imports of the US of rare earth, you know that 90% come from China, right? The total value of the imports of rare earth in 2023 was $20 million US. Millions. Right? You can say, oh, rare earth, right? Now imagine that you have to substitute the rare earth with something that costs 10 times as much. What's the cost? 200 million. 100 times as much. Too bad, right? So we have to, and then something interesting happened in 2024, before the Chinese. American imports of rare earth metals went from 20 billion to 4 billion. Did the American industry collapse? Right? So it just, you have to really be very careful, right? And now there's this story, our F-34s, they need, how many pounds of rare earth, right? They consume this sliver of the total production. And I could go on, right? And that's what I'm saying is, you get these, this rare earth is essential here and there, and technically speaking, this Leontief assumption, right? If we don't have this pound of rare earth, we cannot produce the entire airplane. But you can. It's just one little part needs to be changed a little bit, and maybe it's an epsilon less effective.
Did somebody forget to tell Trump since he tackled out of China, right?
Yeah, but I know it's just actually the United States. If you take the rare earth compounds, the United States has a surplus with China. Yeah. So this is just. But this is among the security people. They would say, oh, rare earth are essential, right? There is a problem there with, let's say, if you are serious, that the Chinese produce most magnets which use rare earth, right? But it's not the raw material, it's the industrial power. And if you take the three big economic areas in the world in terms of industrial production, the value of industrial production, so we have China, EU, US. The value of industrial production of the US and the EU is actually exactly the same, right? The US has a higher GDP because they have software and other stuff, but industrial production is the same. Okay, did I mistreat it or?
No.
Okay,
Okay.
I didn't push this on. And that of China is equal to the US and EU together. These are the hard facts. And then it is obvious that China will have industrial leadership in twice as many sectors as we have, right? the rare earth, in my view, is really not even a footnote. It's this industrial capacity that exists and that we cannot wish away. Right? So that's something we have to live with. And coming back to what Adam says, maybe there are some very specific sectors where we say we wish we had our own, let's say, essential medication and whatever. But to say, let's just apply a principle of economic security everywhere, that's the road into basically closure of our markets, which in my view has very high economic costs.
Thank you, Daniel. Now to Maria. I mean, you, in your work, in your position today, you have the opportunity really to interact with a lot of businesses. How are businesses navigating all this uncertainty and this idea of economic security?
Yeah, so if I may just a quick reaction to Daniel, and then I can give you a bit of my experience with what companies are saying. I'm going to start with the assumption that all problems have solutions. So, and that's what you're saying. If we have a problem, we can solve it. All problems have solutions, so there is no doubt about that.
Not necessarily quick solutions, right? Yeah.
But that's the issue. And so let's not underestimate also the speed at the adjustment, because there are things that in the next, let's say, if you take a medium term, 5 to 10 years, if you were to get into a critical choke point, if I may use the term, which is you could actually, they can be very detrimental to, with knock-on effects. So I don't wish to trivialize the fact that, yes, we can do everything from, it's not really the value of the critical materials trade, it is the significance of the spillover effects, right? Take semiconductors. We produce 20% only of the semiconductors that we need, you know, and then we depend on critical countries for this. If we were to follow the spirit of zero-sum games, which is very much what drives international relations these days, then that can go south very fast, yeah. So I think that's just the only thing I'll say here is that it is the medium, and in fact, when you come to defense. And again, this is the real issue. Let's just, if Russia is sending drones in Brussels airport, or in Denmark, everywhere, in Poland, if there was an attack in Europe today, we are 10 times richer, 5 times larger, we are not ready. That's the part. We will get ready, I have no doubt about that. But that's the time, the next 2 years. What do we do in the next 2 years, and at what cost? What is that cost? Do we really know that? I think that it's important to see this in this context, and after that, I have no doubt that we will solve problems. Now, in businesses, the problem to solve is uncertainty. That's the one thing that they're worried about is they just don't know. 2025, when it comes to tariffs, was the year of back and forth with tariffs. What should they plan? The ability of firms to plan is totally incapacitated as a result of policies that are coming out. Which means that the way to think about operations is you do two things. You control the costs. That's all that happens. Controlling costs is the #1 objective of any firms. And the other thing is you postpone investments. Yeah. So that's kind of interesting. In the summer deal we got with President Trump, there was a little thing that the Commission said that in return for the low level of tariffs that we got, we will have our private firms invest $600 billion in the US, which is a very bizarre thing to come out of the Commission, right? So on what grounds does the European Commission decide commit private sector money to the thing, which is, so that kind of raised eyebrows across businesses. But I actually think it was, and that's my view, it was actually a quiet way of giving Trump a win in the following sense. Investment plans are not changing from year to year. They're committed, right? So when you ask the firms, are you still investing in the US? They say, yes, of course, because this was planned long ago. So in some bizarre way, I think this is what this reflected, yeah? But if you ask the firms, will you plan new investments in the US? Then they say, well, we need to understand what this administration looks like, what the new normal will look like. So I think that's what's going on there. So the issue of investment, and that's what uncertainty means. We just don't know, and therefore we will wait and see. And then, of course, the other thing is China, US. What would that look like? What is the steady state there? And of course, what is EU China? What is the steady state there? And that, of course, I think we are less as Europe because of our fragmentation, and also we started much later. The view that we have on the sort of what kind of relations do we want with China is a lot less developed than the US. The US stays almost a non-partisan view that there is one direction. Probably the wrong direction. If you hear Adam Posen, it is the wrong direction. But they have a kind of a plan. It is the wrong direction, absolutely. It is the wrong direction, yeah. But we have also to understand the fact that China has scale, and therefore, like I said, my EV example was really a remarkable thing, the adaptability of the economy. And what does this mean for us? And what does it mean for certain industries? And what does it mean actually for bigger than that? I think we're not going to solve the climate issue without China. And if you start from that and work backwards, then their spirit needs to be one of cooperation, not of antagonism.
Can I just have a very quick follow-up?
Sure.
You said company, what they do is contain cost and keep investment on hold or postpone. This is going to be to depress demand? Is it?
Sure. Yeah, I mean, that's just that's the national identity, right? Of course, no. You're not going to see the new investments, right? I mean, I'm not pre-committed to investments. The problem in Europe is, can we convince our firms to invest in Europe? All of this is contingent on so many things that we need to do. The Draghi 390 recommendations and many more. So the answer is yes. If we don't invest, consumption cannot pull it up by itself, right?
Okay. Going back to actually moving to the last question that I want to discuss is about policy. And Maria, maybe I stay with you because you mentioned actually what policies can do. And in this town, there is a lot of talks about industrial policy.
next to Chicago here. So very clear, very good.
I'm pretty sure that the views are quite different, but I also know that you have actually looked quite a bit into the literature and what we know about industrial policy. So maybe few insights.
Yeah, exactly. No, I'll maybe walk you through a little bit of things. It's still quite an amazing thing to see how the IMF talks about industrial policy today. By comparison to how the IMF was talking about industrial policy 10 years ago, 20 years ago, yeah. And they use this word where industrial policy needs to be pragmatic. That's why, apart from the incidence of industrial policy, which has shot up in the last 10 years, across the world, actually led by the Western world, to be fair here, it still is quite, for somebody who has, so the DNA of somebody who lives and works in Brussels in the institutions is multilateralism and no industrial policy. Let the market speak. This is their DNA. And somehow we are now finding ways to move away from this DNA, which is, again, against the grain, but I think this is the direction of travel. In terms of what I've learned of the literature of industrial policy in the last 10 years, led primarily by the IMF, and some of the lessons that we've learned by applying successful industrial policy examples, like I'm thinking of Airbus or if I'm thinking of Galileo, and the many unsuccessful examples of applying industrial policy. So what do we learn? And there are many. We were really spoiled for choice there in terms of learning from that. And there are some lessons that are coming here in the context of the need to use industrial policy along other policies, not as the only way to get us out of some of the issues. The first one is economic security, at least in critical sectors or in critical issues. Yeah, it's interesting that Adam talked about the pharmaceuticals. I want to emphasize this because I was reading an article on this where one of the substances that is used for the most basic of antibiotics that we use in Europe and in the US, and this is now with reference to the US, one of the substances used that is exclusively coming from China. So in the US market, and that's why I think Adam picked on it, meaning that if something goes wrong in the relationship between US and China, China very clearly has a tool to use, which is your antibiotics are not being used. This is the most basic of antibiotics. So this is what we mean by choke points, yeah? I'm not saying China is going to do that, or China has any incentive to do that. I don't believe they can. But this is now the frame of mind in which we are approaching our conversations, right? So if you were to identify 3 or 4 of these that are either of criticality for health or criticality for the economy, you can actually invoke the argument of economic security and start at least addressing industrial policy based on that, yeah? I'm not saying that you should apply this to all industries, and I totally agree that no country, no government is in the position of picking the winners, but you can help in certain directions that you define as critical, certainly when it comes to European public goods, which is the thing we all advocate for. But there are good ways of applying industrial policy and bad ways. It needs to be limited. It needs to be timely. You need to have clear exit strategies. It cannot be subsidies without performance. It has to be subsidies for performance, so it's conditional on performance. You need to have identified clear market failures before you intervene. You just don't intervene without a clear and identifiable diagnosis. So that's absolutely clear. And then you need to make sure that you solve the collective action problem, right? Here you can think about risk sharing, or you can think about procurement. I mean, procurement that's part of an industrial policy that's done at the European level. Think of the vaccines that we did that, right? But it has to be well diagnosed. It has to be temporary. And that's actually something to think about. And an interesting thing that we've learned from the many failures is that when you generate demand, you need to make, when you generate supply of a good, you need to make sure that you have also the demand for it. And that needs to be done at the start of the process, not at the end of the process. Yeah. So applying all of this with some realism is important. But again, I do not argue that this is the solution. It is part of the solution. You need reforms. A lot of reforms. You need simplification. You need tax incentives. You need deep capital markets. You need to start. You need to start on the financing. I mean, the financing is really a big problem to solve. And maybe here I can say something about what I was not mentioned in the previous session. This new initiative on the Scale-Up Fund. A Scale-Up Fund is a new fund that is being created amongst the philanthropists. It is a VC, it is a venture capital. It really is about the risky capital. And it is about the scaling up, where Draghi identified a very big gap. So a lot of startups in Europe, but if they want to scale up, they go to the US. Either they're bought over by the US, or they simply are floating in the US. So they go to US stock markets. This fund is there to target those firms, which is actually the ones that they create a lot of value into the economy. And I actually think that the governance of the Scale-Up Fund is very interesting. It's something to watch, to see whether it will increase fast. It's now aiming at 5 billion, which is not very big. But if it were to increase fast, then of course that could be a game changer. For the moment, of course, it's very, very small.
Maria mentioned, of course, industrial policy, but also some other policies. Maybe some...
Can I ask first Maria,
yes.
a question? What is industrial policy?
Yeah, I think, so that's a good point. If you're actually thinking about pure subsidies, which is the least favoring team, certainly from the gentleman to my right. Subsidies, let's take that, which is the least. Procurement is part of industrial policy too. But let's take subsidies. If you have them timely to critical sectors for very specific objectives when there is a clear market failure, you are onto something that could be beneficial.
And nobody is against correcting market failures. But that's tautological, right? If you have a market failure, government intervention. But the question is, how do you identify the market failure? Who does it, right? And do we have a market failure in the chip sector that we need to correct?
We did in masks.
Or you need new markets. We did?
In masks.
In masks, but we were talking about, that's not really, that was a one-time emergency, right? We were talking about the chip sector, for example. Do we need to spend billions? We have had European programs to support the ICT sector for 40 years, right? To make us leaders, right? And the money went always to the incumbents at the time.
Oh, yeah.
Right? So do we need, what's the market failure in chips that we need to correct?
No, I mean, if you're thinking about the big example in Russia, in Sweden, in the north of Sweden, that was totally wrong. Yeah, I think that's it's not a market failure; it's a criticality. It's not a market failure on the chips. Is there a criticality? I think that's the question to ask. Yeah.
Yes, still, so basically, what's the market failure we correct in the chip sector, right?
Yeah. Why don't you tell us what it is, Daniel?
No, I don't see it.
No, I mean, it's industrial policy. It's not teasing a lot of Maria. What is your definition of industrial policy? What is it?
I mean, let's say, to make it concrete, right? The wrong industrial policy is paying Intel, up to 10 billion to build a new factory, fab in Germany, which is really, let's say, one big investment that can go well and not well, but if you pay them about 50% of the total cost, the likelihood that it's actually something useful, I don't see a market failure there, right? But spending the same money on a mixture of research and development, professional schools, and supporting an ecosystem that then can actually, right? That is how we got ASML, not because the Dutch government said, here's 10 billion, right? You have to have this ecosystem, the research and development, the technical schools. That is, I think, industrial policy that makes sense, but just focusing on you get money to do this and that, in my view, in very large % of the cases, goes wrong because the incentives are not there. Most of the important project of common European interest, look at who participates there, who gets the money, the incumbents, the big European companies, right? And why should that lead to breakthrough innovation, or, right? Why should it make them stronger? They basically get paid for something which, if it made sense, they would do it anyway. I don't see a market failure there. And that's why I'm against these large programs that, in my view, risk being misused by, or being misdirected, right, by the incumbents, and B, therefore not correcting really a market failure. So that's why I'm against that stuff.
Then maybe just a follow-up. So maybe there are two things. One is the security aspect, and one is the market failure. So for these large projects, I think there are two elements. One is to whom you give the money and whether there is a market failure. And the other thing is that you may need something that the private sector alone is not going to provide. Because I think, for instance, one of these large IPEC, it's, for instance, air defense, to create this shield.
Yeah, that would be a good idea. I'm not against that, but that's not, if you look at the existing IPCEIs, whatever, most of them are, as I said, they were formerly called CHIPS, and now it's called something else. And let me make a concrete example. Let's say the CHIPS Act, right? The CHIPS Act was meant, okay, let's get one-of-a-kind production technologies in Europe. And then you see one-of-a-kind, or first-of-a-kind, not one-of-a-kind, in Europe. So not really world-leading, but basically things that were not done in Europe. Okay, you say, and then you look at the projects which actually have been implemented. And all of the projects that have been financed went to the national champions, right? So the Germans provided for things that were basically Infineon. The Italian and the French provided subsidies for Italian, the French STM microeconomics, electronics. And all of the projects that were approved in the end were to increase the production or improve the production of chips for the automotive sector. Sorry, this was right to get to the forefront. In the end, it turned out because the automotive sector in 2021 had a problem in Europe. Why? Because when the chip shortage hit, when the Corona came, demand for cars plummeted. And they said, just-in-time delivery, we stop our long-term running contracts for chips. The chips then said, okay, now we have a strong demand for entertainment business and other electronics, consumer electronics, so we switch our factory. It takes some time, right? You have to recertify. And then the European producers come 6 months later and say, oh no, we made a mistake, we need the chips now. And they're told, sorry guys, not available. And then the European Automotive Association said, oh, we need to have more domestic production of chips to be secure in our supply for our automotive industry. So the entire thing, in the end, is a subsidy for the European automotive industry because they made a mistake. And that is then sold as supply security. And then when comes the next chip shortage because whatever, then do we want to have then saying, okay, we don't export chips anymore to whatever, to the other automotive producers? And then they saying, okay, we do the same thing with you, right? So I find this entire strategy as misleading. And in my view, there was no market failure. It was just a mistake of our producers. And they, of course, say, oh, we cannot produce cars, right? What happens during that time when there was this shortage of chips and therefore reduced car production in Europe? The profits of the automotive producers in Europe increased because, right, it was like they had formed a cartel. So I think the entire storyline gets so distorted by sectoral interests and by superficial security considerations, and that's why I'm saying it's to be extremely careful with industrial policy.
So maybe just picking up on what Adam also said, maybe what we need to do is to make an assessment ex ante of what the vulnerabilities are in certain strategic sector and to identify where there is need for policy intervention, which probably is not cross-cutting, but you really need to do something ex ante because I think vulnerabilities exist. But maybe I'm going now to Eric. Maybe your thoughts both on industrial policy and the extent to which actually we need to look at a broader picture.
Sure. So I get the last word here from. So I said something on industrial policy very quickly, and then some more concrete about what I think we should do on the policy side, as you said. On industrial policy, I think as economists we can all agree that it's not good, right? We should just educate people and let the market sort this out. But that's not reality. I mean, if it is because the world has changed and there are some who play by slightly different rules and different system, and therefore we can, of course, sit back and accept that in this case here, for example, in my native Denmark, all the windmills, we were the leader. The company was bought by a Chinese company. It was all moved away. We don't produce any of this stuff anymore. And then we say, okay, we find something else to do instead, right? Well, we can do this. Within a 2 or 3 year period, just after COVID or around COVID at the time, virtually all public buses in all of Scandinavia virtually were replaced by Chinese electric buses. Company came and said, you know what, we can get you these beautiful buses and clean and for a very low price. So we're all driving these beautiful buses around. About a month ago, there was some Norwegian guy who picked it apart and realized they can all be deactivated from China. What do we do? Now, so my point here is there's a reality, and then there's what we as economists would like to have. And I know what is strategically important. Well, I mean, if there were to be security issues and you have to move security people or soldiers around, buses are kind of good to have, right? We can't drive them today. They don't start, right? I mean, so the point is, there's no fine line in this, this is what policymakers are for. I accept every single example you give, and we can find them all. It's not efficient, and the total growth and income growth we get when we have industrial policy are almost certainly going to be less than in a purely free market. But that's not the world we're living unless we can cut the trades. No. No. If you must. So I think the reality of this, and this leads me then to the second point. Sorry, you again. But it's like the point here is that there is policies. Elected politicians are there to set policies with a vision of what you want. That includes safety and security of all these sort of things, right? Let's not fool ourselves. That's what the objective is. But you need to generate the growth, and you're obviously interfering with taxation, regulation, and everything in daily life all the time, right? So here's the concrete thing I'm going to say. We need definitely to have more investment in Europe in order to increase the productivity numbers. Clear. The Draghi report, 800 billion a year in extra investment, clear, and we can discuss the number. It doesn't matter, but few people would disagree that we need. I think we in Europe, we are jumping too quickly from that to the capital and banking union to we can allocate the capital much more efficiently. But that doesn't generate the 800 billion or whatever the real number is. So there are two steps to it. And this is where I disagree with what Judith said in the previous one. We have a saving surplus of about 400 to 500 billion a year, which is the current account surplus, right? This is money we are sending abroad. Why are we not incentivizing the capital market to keep this money here? Because the world is now not perfect. We have a Donald Trump who is impacting the trade numbers by tariffs, not a lot, but this is the way. So why are we not impacting our capital export when we want the money here? Case in point, European financial institutions bought last year $72 billion worth of US Treasury bills. The Chinese have seen the game long before us. They are net selling every single year, as they should, if I were them, right? Why are we saying it's a great idea for our insurance companies or pension funds or whatever to buy Donald Trump's deficit and finance it when we could finance it here? Well, there are two reasons. They are regulated to have a lot of money in so-called safe assets, and they pay a bit more in dollars than in euros. So I would argue do two things. Change the regulation to encourage risk-taking by these institutions and put a tax on export of capital. Why should we? Why is Donald Trump's deficit really safer than the Spanish deficit or the French or the Italian or the German or whatever, or the ESM number seems to be talked about? This is a play, the deficit are bigger than anything we have in Europe. The debt is higher than anything apart from Italy, what we have in Europe, right? And we have people close to the president who says repeatedly on different occasions, not direct decision makers, that maybe we should take the foreign holding of this and force them into 100-year papers at low interest. You hear this once, that the credit rating agencies don't immediately downgrade them significantly is a mystery to me. Why should we live under that regime when we have the tools to redirect the money to stay here? So you can call that industrial policy. It's a capital markets policy. We have an objective to get the money invested here. And then we need to allocate it efficiently. Capital markets union, banking union, wonderful. But more important than that, the incentive structure to, via regulation and via taxation, to encourage risk-taking in the equity market and startups and all the rest of it.
Eric, can I just a follow-up question? Because I see your point, but why are actually investors still investing so much in the United States?
Because it's safe assets. It's seen as safe assets because they're regulated to do it, right?
But if the US debt has become less safe, why are they not changing strategy even more markedly?
If you are a pension fund portfolio manager in Europe and you have to have X in AAA rated, you buy AAA rated, and you will not be slaughtered for losing money in the US Treasury market, but you might be if you bought Greek bonds, right?
So the problem is the rating agencies and the fact that investors need to follow the rating agencies' safety indicator.
Right, exactly. And then let me just say, just to provoke you further, if I manage to provoke you a little bit, or provoke you a little bit more. So go back to what I said in my first segment. We had the great years of globalization. That was identified with freer and freer trade in goods and services, more and more people free movement around, right? And free capital movements. Over the last year and a half, or thereabout 2 years, we have seen infringement on the trade, free trade, and we are seeing infringement on a daily basis on people movement free. Why should capital owners be the only segment that still has the right, without any interference of regulation or taxation, to roam the world to allocate the capital as they want? Why is this not a legitimate policy objective to say, I have an opinion where our savings surplus as society should be invested, and I think it should be home sourced? I think that's a completely reasonable thing to say, and I think policies should be set in accordingly.
Anyone who would like to react to this?
When you ask, we do a survey on.
I worked in a bank for 30 years.
In fact, when you ask the CEOs If you could afford one change, would it be tax incentives for you to stay? They will always say no simplification. All I want is just the regulatory burden to be simpler. I mean, just to show that you may not even have to go down that route to get more jobs.
So may I say that on regulation, it drives me crazy, right? As I said, for 30 years I worked as a European or global economist in European banks here. And every time you go to corporates and say, what do you kind of think? Oh, less regulation. You know, well, let me tell you something. I hated regulation when I had to renovate my grade 2 apartment in London, because they come and say, oh, you have to do this, otherwise in the spirit of it. But then I got it done. Now, bloody hell, one street over, somebody wants to build a higher building than the community had originally planned. Now I'm certainly in favor of regulation. He should not be allowed to do this. So like, tell me, when people say, I don't want regulation or less regulation, I think we have to ask them, which one? What regulation? There's not a single piece of regulation that's been introduced just for fun, right? We can decide when they come and want to build a car factory, a battery factory in Brandenburg, we can decide, if we want, that what we thought 20 years ago, that if you do this, we have to have an environmental standard for whether frogs or whatever there is, that it takes, we have to get these surveys done. We can decide we don't want it anymore. That's a political decision, right? But then tell me which one they are, right? Because otherwise von der Leyen or the Commission, well, we're going to reduce regulation and reporting by 30%. Which one? Well, it's mostly reporting, right? So it's like, but which regulation is it? Everything one has been done for somebody. And we can decide that we changed our mind that somebody is not important anymore. But I mean, it's like, it drives me a bit nuts. And to be honest, as an economist, I think there is nothing that works as beautifully for businesses and private people as financial incentives. You give them an incentive. You tell these companies that, you know what, we're going to change the law. So if you're investing in Europe, you're going to be able to front load all your write-off on your investment. I would bet you a fair amount of money that you're going to get more investment.
Daniel, do you want to react?
Chicago.
Let me just react with some, for me, relevant facts, and that perhaps finish with a question to Eric. The productivity of investment within the EU is much lower than the United States. If you take the ICOR, for example, increment capital output ratio, if you take most stock market indicators, even if you take interest rates, it's a fun fact, I will put that aside. If you compare, between now and the year 2000 when the euro was created, the exchange rate of the US dollar and the euro has been exactly the same, almost, right? In the meantime, US bonds have yielded 10, 20 percentage points more. So much for the exorbitant privilege of the United States. But you can understand why insurance companies and others say, right, past is no guarantee for the future. I rather invest there. But now let's come back to it. We need more investment in Europe. If we have more investment in Europe and the way we invest is not changed, would mean that the return on our investment, macroeconomic speaking, right, can only go down, and it's already lower than abroad. What sense does that make? I don't see it. Now, perhaps Eric will say, okay, but we increase the efficiency by which we allocate capital. Now, okay, would you say we put the capital export tax aside until we have had a deep reform of our financial system? Would you agree with that?
No.
Okay, so you would have the capital tax first. Okay, in that case, my point of view would be, in that case, meaning keeping more money in the EU at a very efficient, at a point where already our marginal returns on investment at home are very low, means more of the same, even less return on investment.
it's a chicken or egg issue, really, and it's. I don't think we need to have. You have to do this one first, and all the rest of it. So, but sort of directly on that point, are we going to wait till we have a capital markets union or another thing? No, I mean, I think we can, if we can identify a couple of things that clearly would help. We need more investment, so we have to put incentives in place for these investment. There can be carrots and there can be sticks, right? And my point here is there should be some carrots, and particularly for investment in businesses that create jobs and and productivity, hopefully. I think we can do it with a tax incentive. That's why I gave that example of front loading the write-offs. I don't see any problem, in my book at least, by introducing also a stick in terms of increasing the cost of passive money going to fund Donald Trump's deficit. We would never be able to say it like this, right, outside in the bigger world, and maybe we have to say everything outside the Europe, but maybe it comes back to this issue. We Europeans haven't figured out, and this is what I meant by the depth of the cooperation versus the broadness. We haven't figured out what a currency union really is. So we are still going around and treating some members of the Eurozone's governments as inferior creditworthiness to Donald Trump's America. That's crazy, in my opinion, right? That is just insane. And it's possible that these three Anglo-Saxon-owned credit rating agencies think that way, but they're wrong, right? So we have to make very clear that that if you're buying something that is underwritten by an authority, a government authority in the Eurozone, that's risk-free in the sense of regulation, period, right? And I think when somebody is not only, now Greenland is not part of the EU, but damn close, right? Saying, I might take it by military force, right? And I am going to put these terrorists on. So he's not our friend, right? Let's just be very clear where we put our money now. And I don't see any reason why we should not consider seriously of putting 0.5% or 1% tax on that basically takes away his interest rate advantage. And yes, there may be that for a year, 2 or 3 or 4, that the marginal return on those are lower, but that's a chicken and egg problem for me.
Okay, maybe I take just a couple of minutes if there are a couple of questions quite quickly, which we try to address. I see 2 ladies there, if Jiffer can help. I think because we missed the mic. Sure.
So thank you, very interesting discussion, very interesting. Not in English. But I wanted to ask you about artificial intelligence, something we haven't talked about a lot. And this is an area that Europe says it wants to be a world leader in. But artificial intelligence needs data centers. We have a lot of cheap energy. We want to be net zero by 2050. These are huge challenges. We need also the personnel to run the network, facilities, buildings. Is this an area where you think industrial policy should be applied? I know what Danielle is. What are those things? Is this an area that makes sense? We have one French company which is doing this very well. What do you think about this and in terms of future?
Maybe also there was another question.
It was actually the same. Not the same, but the same. Because to be honest, when we started the serious discussion about industrial policy, it was a reaction to the IRA. Hence, I mean, we should remember how we had a big focus on green decarbonization, etc. It was not only about the semiconductors. So if you think of it from that point of view, and to be honest, I don't think we had a number of them. I'm not sure exactly what was the outcome of all of this. How would you rate what has been done so far? And now we have an accelerator that will come in 1 or 2 weeks, right? Have this been successful so far? What could be done differently? And again, focusing not only on the tech side, but actually on the green side, was, I think, to some degree needed as well after the big regulatory green deal. How do we help support this year align with the ETS and if you can comment on that.
Thank you. Anyone who would like to take one or the other? AI and yeah,
Yeah, I mean, on AI, I would, if security experts tell me, that's not me, but if a security expert tell me that this should really be home-sized, then it's industrial policy, and I'll support it. Very simple, right? Security should be, in my view, a European. We should be together in this, and if we cannot trust to buy these services from outside, then we should do it. And so for me, it's not controversial to. I used to hate industrial policies. I worked at the IMF, but it's like, so I think that the answer is quite simple. That I accept the fact that security has become the priority over economic policies, and I also accept 100% that almost certainly will lead to less efficient economic policies. But that's the life we live. Unfortunately, the world has changed, right? So that would be my short answer. On green, so I'm not an expert, but my view on the whole green transition is that way too much of it was done by regulation and forcing even banks to rate companies, and it became so big matrices that were set up. And I would have loved to have done it with financial incentives. I would have said so you could possibly have made it fiscally neutral, but in a sense, even if you couldn't because of political obstacles of taxing diesel in France or whatever, I would take it as a fiscal cost, because at the end of the day, in my opinion, if we don't get this right, there won't be any Europe in 50 years or whatever it is, right? I don't know the number, like kind of thing. It's like, this is existential, right? But so is it to deter Putin, right, from taking our countries, right? So I think we have to identify our priorities and then take the cost of it, right? But that's what the German government certainly learned, and the French government is politically extremely difficult. So that's why I'm not a politician.
Maria?
Yeah, maybe just a few thoughts on AI as well. Also, in view of what we heard also in the first session, to differentiate between AI adoption and AI as the frontier research, I think that this is an important distinction. On the adoption side, I was a little bit surprised to hear in the first session that we are lagging behind. AI adoption in the firms, on the firm level, is all the talk, from HR to finance, production function. This is how businesses are. But so you have, again, the time element here is important, right? I mean, if you're trying to adopt we have adopted an AI strategy also at the conference board because we want to try it. But whether we're going to see productivity gains, I think that's the important thing. Once you start identifying where you see the productivity gains, then you go all hands-on, yeah? But I don't think it's fair to say that we are not trying to adopt AI. There's just so much of this that is being experimented with. On the research side, I think your point about energy is important. You might have seen Google investing in space now for energy, which I thought that was a very fascinating thing with all the geopolitical implications of having energy being transferred from space into back to Earth. But there I would like to maybe repeat the argument that Kalin made in the previous session. We have something about 600 billion invested on AI this year. This is the big tech. 600 billion. No, the investment that we need in Europe is 800 billion. This is just huge money. And all the talk, I think in 2026, is going to be about, can we see returns on this investment? Do we see the returns on this investment? And if we don't, then we were talking about a bubble. And then the question is, and again, what we talked about in the previous session, if that were to be a bubble, and it were to burst, will it be confined, or will it be another financial crisis? I think that this is not trivial points, given the amount of money that is involved in this investment. Yeah. So I would like to see some returns on investment before we can sort of decide, given the objections on industrial policy, whether we go invest on this. I would much rather invest on the green. We know that we need it, and on AI we just have to be a little bit more cautious, I think. You have it in mind.
You want to say something, Daniel? Una parola, one word.
On the green, we have in Europe, as one of the, I think, the only large economic area, we have an excellent instrument, the emission trading system, ETS, which puts a price on carbon, for the time being limited, but we have the ETS2 coming on stream, which puts a price on carbon basically to the entire economy. China has something similar with a much, much lower price. when you have additional measures, regulatory measures, to what extent do they reduce our emissions? The answer is zero, because our emissions are already in the past predefined by the ETS. And if you tell some sector you have to adopt certain technologies or do certain things to reduce your emissions, it only means that the price for emissions will go down and you have more emissions elsewhere in the system. So this superabundance of additional regulation only increases the price of the transition and probably yields very little. Certainly it yields zero lower emissions in the sectors covered, because there you already have you have the path given. So anything in addition doesn't change this path. And that's why I don't understand. I'm not saying that the ETS should be the exclusively only system, but that is the mainstay of the policies of our approach, which is the best one, I think, from an economic point of view. Let it work to the extent possible. And therefore, my view is that a very large part of the additional regulation coming through the Green Deal are actually only increasing the price and not changing the result.
Okay, I think we covered really a host of topics, and views are quite different, so there is no single recommendations, but I hope this extended your understanding of the issues. We are closing. Many thanks for bearing with us. We went a bit over time, and now we are going to move to the last closing keynote, which is online. But in the meantime, let me thank all the speakers for sharing their thoughts and for coming. Many thanks. Yeah, I think we're trying to see if Barry is online, because I will ask. Okay.
Right, that's right. So this story is again, this is being used, so we cannot buy some Chinese classes because they might stop our kids from the room. Sure. And this is I'm aware of this income, right? But I'm not taking it out. Yeah. Oh, wait a minute. That's Barry. Hi, Barry. Where is he? I saw him just a few days ago. Is he back? Let's do it like this.
Hi, Barry. Just want to say hello.
Good morning, Daniel.
Okay, everyone. Hi, my name is Jiffer Bourguignon. I'm with Intereconomics, and Barry Eichengreen is an economist who needs no introduction. That said, I am now going to introduce Professor Eichengreen. Barry Eichengreen is the George C. Pardee and Helen N. Pardee Chair and Distinguished Professor of Economics and Political Science at the University of California, Berkeley, where he has taught since 1987. A research associate of the National Bureau of Economic Research and research fellow of the Center for Economic Policy Research. He has a regular monthly column in Project Syndicate and is the author of numerous books, a long, long list, including The Spread of the Modern Central Bank and Global Cooperation, 1919 to 1939, In Defense of Public Debt, and How to Achieve Inclusive Growth, just a few among many. One could go on, but instead I am going to hand it over to Barry.
Thank you very much for that brief but effective introduction. I'm sorry not to be able to be with you today. I think I was last at CEPS right before the pandemic, and I hope to be able to repeat that experience in the not too distant future. So I will try to share my screen. and move to doesn't seem, there we go. All right, is that visible to one and all?
Yes, Barry, we can see it. Thank you.
Okay, very good. So the topic du jour in some circles is stablecoins, and in particular, the initiatives that have been taken by the Trump administration and the US Congress to harness stablecoins in the interest of dollar dominance. So I'm going to talk about the bill passed by the Congress and signed by President Trump in July, the Genius Act, about the stablecoin challenge, such as it is, and about what, if anything, Europe should do about it. So one goal of the Genius Act is, in fact, to solidify the international role of the dollar. So many different forces came together to build political support for this initiative, including lobbying from the crypto industry, some other business interests that I will not specify at this point, but also the notion that the Genius Act might be used to cement dollar dominance in an increasingly digital world. So what does the Genius Act do? To remind you, it authorizes the issuance of dollar-linked stablecoins that are designed to trade one-to-one for actual US dollars by banks, by non-bank firms, by tech platforms, including by non-US banks and tech firms if they are in compliance with the provisions of the Act, and if their stablecoins issued in the United States are linked to the US dollar. The Act provides for multiple regulators. The Federal Reserve can regulate member banks that it already regulates. Their subsidiaries will be permitted when in compliance to issue stablecoins. The comptroller of the currency will regulate other issuers, Walmart, Amazon, Bank of America, who knows who. And then in the 50 individual state bank regulators can authorize the issuance of stablecoins as well. The state bank regulator of Wyoming, for example, being in the forefront of this endeavor. The Act requires redemption on demand at fixed value. It requires holding 100% reserves or backing in the form of, quote, highly liquid and, quote, low risk reserves, which means in practice bank deposits, short-term US Treasury securities, money market mutual funds, and, quote, other similarly liquid assets. So from the terms that I am putting in quotation marks, you can anticipate some of the issues or questions to which I will return. The Act requires monthly examination, light touch examination, and more comprehensive annual audit of the balance sheets of the issuers of that backing by registered accounting firms. And it prohibits paying interest on stablecoins. That provision was adopted in response to the bank lobby, which worried about bank deposits shifting into stablecoins, resulting in disintermediation. There's a loophole there to pay attention to. The Act doesn't say anything about exchanges, the digital secondary market on which stablecoins are traded, paying interest. And it doesn't say anything about the issuer transferring funds for use in paying interest to in exchange. So I don't think we can rule out some disintermediation ex ante. As I said, one goal of the Genius Act is to solidify the international role of the dollar. And I have various quotes here. I won't go through them all. The two lead sponsors of the Genius Act were Bill Hagerty and Kristen Gillibrand, both in the Senate. Hagerty said that the Genius Act would cement US dollar dominance. My point, protect consumers, increase the demand for US treasuries, and ensure that innovation in the digital asset space is in the hands of the United States of America, not our adversaries. I'll leave to your imagination who he was talking about. And Gillibrand asserted that the Bipartisan Genius Act will provide regulatory clarity to this important industry. And I would agree that regulatory clarity is important. The question is how clear the clarity is. Will keep innovation onshore, add robust consumer protection, and reaffirm the dominance of the US dollar. So you see that developing theme here, which appears also in US Treasury statements, White House fact sheets, and so forth. How might the Genius Act do this? The underlying idea is that dollar-linked stablecoins will provide a faster and cheaper set of payments rails, not only for domestic transactions in the United States, but also for cross-border payments worldwide. It will be faster and cheaper than the existing correspondent banking system and its messaging arm, SWIFT. If this enhances the attractions of dollar payments, then corporate treasurers will be encouraged to maintain inventories of dollars. Central banks will be encouraged to hold reserves of dollars so they can provide them to their corporates and banks in times of need. So this is the logic of Geeta Gopinath and her co-authors when they write about complementarities between payments and reserves and other functions locking in a dominant currency, in this case, the dollar, given that 99% of stablecoin circulation worldwide takes the form of dollar-linked stablecoins, making the US the first mover in this domain. So there is a challenge for governments and central banks around the world, in Europe and around the world. Continued dollar dominance is a mixed blessing. It means continued exposure to US policy uncertainty, to US debt problems, to potential further weaponization of the dollar. It creates the danger of currency substitution as locals move away from the domestic currency toward dollar stablecoins for payments and other functions. And it does open the door potentially to money laundering, tax avoidance, and capital control evasion. So how should governments and central banks in Europe respond? The alternatives, in my view, are 5, do nothing, attempt to ban the use of dollar-linked stablecoins, issue competing local currency stablecoins, link fast payment systems and tokenize bank deposits as a way of creating an alternative set of digital payment rails, and issue interoperable central bank digital currencies in an effort to crowd out, to dominate private label stablecoins. So let me talk about those alternatives in turn, and then I'll give you my recommendation briefly. Possible response number 1 is to do nothing on the grounds that stablecoins will not, in fact, enter the mainstream of payments. Dollars held on deposit with US banks are insured. Stablecoin holdings are not. We know that stablecoins are not always stable, so potential holders and users may worry about the absence of the equivalent of deposit insurance. When Silicon Valley Bank failed in 2023, Circle, the second most important stablecoin issuer, which held deposits at SVB, saw its stablecoin go to a discount. The big money market fund, Reserve Primary Fund, which held its reserves basically 100% in treasury bills, went to a discount in 2008. There are questions about the fungibility of stablecoins. Will Amazon coin be usable at Walmart? Will Walmart coin be usable at Amazon if hundreds or thousands of stablecoins are issued? Will the major exchanges be able to make an efficient market in them? And the correspondent banking system and SWIFT are not standing still. They are experimenting with blockchain, with fast payments, with the tokenization of bank deposits. So maybe stablecoins will prove to have been a passing fad. And in Europe, especially, the danger of currency substitution is less because inflation in Europe is low and stable, in contrast to some other parts of the world. Possible response number 2 is to attempt to ban dollar-linked stablecoins. So China has attempted to do this. It, in fact, banned all crypto in 2021. And my list of other countries that have done similarly is Algeria, Bangladesh, Nepal, Bolivia, and Iraq. But few other countries have followed them down this road to date. And moreover, China has, there are problems with attempting to do this, as you will anticipate. While China has blocked wallet services, restricted accounts on crypto exchanges, banned advertising, a recent IMF study by Reuters documents significant stablecoin activity by mainland China entities. So that study uses language, script, and regional references to identify a wallet's likely location. VPNs and so forth would prevent you from directly doing so. So he attempts to do so indirectly, and he estimates significant net flows of stablecoins in and out of China in 2024. As I have anticipated, attempts to ban dollar-linked stablecoins can be circumvented in various ways. Businesses can legitimately acquire stablecoins offshore by exporting. Individuals can use VPNs and other specialized apps to mask their IP addresses. And the big crypto exchange, Binance, actually provides guidance on its website on exactly how to access its platform via VPN from China. So you might well ask, how effective could such bans be, especially in a part of the world like Europe, where ability to regulate the internet is rather less. Possible response number 3 is to issue competing local currency stablecoins. Japan has put in place a regulatory framework to do so. Singapore has put in place a regulatory framework to do so, where notably that framework allows for the issuance in Singapore of stablecoins linked to the Singapore dollar, but also linked to other major currencies like the US dollar and the euro. Interestingly, Hong Kong has put in place an ordinance recently allowing for Hong Kong dollar linked stablecoins. And you know the Hong Kong dollar is linked 1-to-1 to the US dollar. Alibaba, Bank of China, other big players have basically applied for a license. And that logically raises the question of whether China may eventually bring this experiment on shore. Hong Kong is a petri dish, a sandbox for financial experimentation for Beijing. I think it's unlikely that this will be brought on shore because China's capital controls would be jeopardized. China could try to regulate use of Hong Kong dollar or ECNY stablecoins by adding smart contract programmability, linking use to China's digital ID system. But I wouldn't want to have a Chinese digital ID and have China be able to surveil my stablecoin transactions. So I think this prospect is unlikely indeed. And Europe Circle offers a euro stablecoin. It's acquired an e-money license in France. There is a consortium initiative. 9 major European banks are joining forces to issue a new euro stablecoin. This will be regulated under the EU's markets and crypto assets regulation framework. How far it will go, we will see. Possible response number 4 is to link fast payment systems. So to remind you, fast payment systems like TIPS in Europe do not run on blockchain. They run instead on standard cryptography used also by banks and others. And they're in fact faster than stablecoins when linked across borders. It can take you or me 5 to 10 minutes to on-ramp a US dollar to a stablecoin and then off-ramp it to a euro in a cross-border transaction. If you have experience filling out reimbursement forms for conference expenses, you will know of what I speak. So linking fast payment systems may be more convenient. The transfer is in actual bank money, not in fragmented stablecoin form. But linking these fast payment systems across borders requires laborious negotiations to harmonize standards and protocols. It took Singapore and Thailand, which have such a link, 3 years to finalize and operationalize that agreement. There is something called Project Nexus of 5 Asian central banks to kind of standardize those protocols. And the ECB is apparently talking about joining Project Nexus, still at the experimental stage, but expected to go live in 2027. You can see that agreement on standards and protocols, this mapping of such agreements from the ECB is heavily regional. It seems to be easiest to link fast payment systems with your immediate neighbors. Links decline with not only with physical distance, but with geopolitical distance measured as is commonplace by conformance of voting patterns in the United Nations General Assembly. So this may work for Europe in its immediate neighborhood. Whether it will work more broadly is an open question. And finally, interoperable CBDCs. CBDCs are being widely piloted. They offer speed, safety, and finality, settlement in bank money, but their use, take-up is slow, even in China, the pioneer in terms of issuing CBDC. The ECNY accounted for just a minute fraction of the Chinese stock of bank money in mid-2023, the most recent date for which we have data. And cross-border use is limited by all the same factors that limit local currency settlement. So at the moment, to use the ECNY, you basically have to be resident in China. So there is a solution to that, to build a dedicated platform or a single blockchain, a private blockchain on which different CBDCs can run and be exchanged for one another. The well-known one is Project mBridge of the central banks and monetary authorities of China, Hong Kong, Thailand, the UAE, and now Saudi Arabia. This thing works. The protocol was written in the Digital Institute of the People's Bank of China. The dashing protocol that validates transactions was written in the Digital Institute of the PBOC. So there are actual transactions already being made using this system, but the fact that it is a China designed and it for the moment China dominated system suggests again that it might be used in a limited sense to settle transactions in East Asia, maybe to settle China's oil trade with the Middle East, but it seems unlikely that the European Central Bank or the Federal Reserve would join such a system for the foreseeable future. And then there are technical issues to be resolved. Enbridge is not fully integrated with the traditional payments system. And there are political problems to be solved as well. What's the decision-making procedure for governing the system, for maintaining the system, for admitting additional members? Now all such decisions are made by consensus among the 5 members. What will be the voting rule when there are 25 or 45 members? One country, one vote? I think not, given that this is a China-led system. So conclusions and recommendations. What do I recommend? I think the alternative of attempting to ban the use of dollar-linked stablecoins is limited to countries where government has strong control of the internet and of financial transactions of all kinds. Under these circumstances, under our present uncertain circumstances, I think the prudent strategy would be to diversify, to explore the development of a local currency stablecoin, to link fast payment systems to those of other countries, to pursue the tokenization of bank deposits, and to continue studying, piloting, and rolling out CBDCs. So I interpret China's recent modest step of allowing Hong Kong to adopt a stablecoin ordinance as similarly diversifying, not only relying on its central bank digital currency, but exploring Hong Kong dollar linked, ECNY linked stablecoin as a hedge against the possibility that there might in fact be significant take-up of dollar-linked stablecoins. So if China is not putting all of its eggs in one basket, I would argue that Europe should not put all of its eggs in one basket. It should similarly explore a euro-linked stablecoin, linking fast payment systems, tokenizing euro-denominated bank deposits, and continuing to explore central bank digital currency. So with that, let me say thank you. If we have a little time for questions, I am happy to take them.
Very information-packed presentation. I'm sure everyone here has questions, and I will be happy to pass the microphone. It's off. Okay. Oh, that's better. Thank you very much, Barry, for that very interesting and very information-packed presentation. I have a question before I pass the microphone on to the audience, who I'm sure have a number of them. I was wondering, you mentioned Binance, that is as perhaps some know, the head, if I remember correctly, of Binance was pardoned recently by President Trump, and is also one of the main investors in his son's Liberty venture. What role does grift, or does the impression thereof have play in this? Is this something that is an issue?
So I had a little trouble hearing, Jeffrey. You used the technical economic term grift.
Yes, I did. And I was wondering, because you mentioned Binance and the pardoning of the Binance founder. And as perhaps some people know, he has been an investor in the Trump Sons Liberty venture into crypto. What role does grift or the impression thereof play in this?
So my talk is one about economics, finance, and economic policy. I don't want to go down the rabbit hole of corruption in the United States, but to all appearances, there is something there. What is it? World Liberty Financial is a crypto firm of the Trump family with a stablecoin as one of its products. If you look to the Congress, I would argue probably that campaign contributions are more important than the kind of grift to which you refer. But you know, there is so it's up to each individual to decide whether this is a business proposition with a policy rationale attached, or a policy agenda, including cementing dollar dominance with a business proposition attached. It's clearly both.
Okay. Cinzia?
Yeah. Hi, Barry. Many thanks. I'm moving here because I assume that you can see me if I'm here. So I actually two questions. So the first one, from your talk, I understand that you expect stable coins to expand. My question is the United States going back to the pre-Fed kind of period where basically we had a lot of different issuers of money? And in this case, the singularity of money may not be granted because the value of the different coins may be different. So is my understanding correct, and whether you could expand on this? And my second question is, you mentioned mBridge. I understood that the initiative was somehow killed by the BIS, but maybe I'm wrong on this. Thank you.
Yeah, so I am a stablecoin skeptic. You will have observed that there is a strong age enthusiasm gradient for all things crypto, and that includes stablecoins, and I'm increasingly on the skeptical side of that gradient. But I think it is incumbent on us to understand what stablecoins are, make a judgment of how widespread we think take-up is going to be, and formulate a policy response, or at least contingency plans for dollar stablecoins if they really become a thing. Among other things, they are almost certain to become a thing, to experience significant take-up from people engaged in money laundering, tax evasion, terrorist finance, and so forth. They are already used as on-ramps and off-ramps for other cryptos. You put your money in a stable coin and you wait for the right time to buy Bitcoin. That may change with the correction of the crypto markets. Who knows? But if stablecoins do experience widespread take-up, I think there is a free banking style scenario between 1836 and 1862. Banks were subject to capital requirements, but subject to those requirements, they were free to issue their own banknotes. They were similarly obliged to redeem those banknotes for $1 worth of gold at the official gold price. But there were good regulatory regimes where those banknotes held their value, as in the state of New York, and bad regulatory regimes where banknotes went to deep discounts in Minnesota, in Michigan, elsewhere. that destroyed the singleness of money and created significant complications for the efficiency of the payments system in the United States. I think that history is relevant, as you suggest, and that safe and liquid collateral can quickly become unsafe and illiquid with negative consequences for the efficiency of payments and the singleness of money. So I do worry that we're going back there, which I think would be unwise. On Project Enbridge, the BIS basically provided coordination services for the four national central banks and monetary authorities that were involved in the initiative. And I think it was late in 2024, the BIS withdrew from the project, but the project lives on. And it appears that the value of transactions that are actually being made through Enbridge, while relatively low compared to the major European and North American clearinghouses, is continuing to grow over time. The five central banks and monetary authorities involved can manage and grow the platform without help from the Hong Kong office of the BIS.
Thank you very much.
Can we open it up to the audience? I think there's one right here in front. Daniel, would you like to?
Hi, Barry. I'm a fellow stablecoin skeptic. An observation then leads to questions. The first one is everybody says, yes, the Genius Act was made to foster the adoption of stablecoins and therefore also dollar dominance. Now, we in Europe have the MiCA, and if you put the two side by side, Genius and MiCA, I don't really see a difference. Now, I noticed in your first slide you had the words examination and audit in inverted quotation marks, and you promised you would say something about that. Did you want to say that there won't really be implementation of the requirements of the Genius Act, or not? What should we expect? I think that's very important to know, because if the Genius Act is implemented fully, then it is at least as restrictive as MiCA, and already we know that the largest US based stablecoin USDD is not compliant with the Genius Act. And so that brings me to the second question. In what sense can one expect the Genius Act to foster dollar dominance? And that has two questions. A, should we expect a large uptake of stable coins around the world? And as you already said, so within the euro area, clearly not. Within the United States, I also think not. So it might be just used for some transactions with countries which has less stable monetary regimes. And the IMF study that you mentioned closely goes into that direction. But even granted that there might be some adoption in the global south, would you then expect this stablecoin to be addition to existing holdings of dollars, or just a substitution? Because if the stablecoins just substitute local dollar bank accounts or local dollar cash holdings, then I can't see to what extent the stablecoin success would actually cement dollar dominance. In particular, if stablecoins substitute for dollar cash, there might be a net loss in terms of seigniorage for the United States Treasury. On cash, you don't pay interest. On stablecoins, you pay some. Sorry for this long question, but I thought we have some returns from your online presence for these very important issues.
Thank you, Daniel. So let me start with the second. When I said the one idea is of licensing dollar-linked stablecoins is to cement dollar dominance. Globally, what I meant is to slow or prevent the erosion of dollar dominance. So I think what you're saying is true, that at the moment when a worker in the United States sends remittances to Latin America, he or she uses Western Union, which is basically transferring bank money on the Western Union having accounts in different countries and correspondence in different countries, but charging 5 or 8, as much as 8% for a small transaction. Competition is going to arise in this space. There will be, if not stablecoins, something else in the digital sphere. So the idea is to provide a system, a set of payments rails that are cheaper and quicker than whatever other alternative comes along to potentially challenge dollar-based payments being transferred across borders by incumbents. On your earlier question, we don't know exactly how the balance sheets of stablecoin issuers will be examined and audited. There is some fairly general language in the Genius Act, and over the next year and a half, the US Treasury will lead a committee of different government agencies, the Fed will be involved, to build out the regulations that put flesh on the bones of the Genius Act. But I think the consensus interpretation is that there will be audits and examinations by publicly recognized auditing firms. So who they are exactly, if you've followed the stablecoin sphere, Tether, for example, has used some very obscure, not very well-known auditing firms. So exactly who the auditor will be important. And if there is a light touch examination, I look at the balance sheet monthly, but I only really take it apart annually. 12 months provides a lot of time for mischief. So I worry about what can happen in the interim between the systematic annual audits.
Thanks.
Do we have, maybe would you like to come to the front and you can ask Barry yourself?
Okay. So, Professor Barry, I'm a Chinese diplomat working for the mission of China to the European Union. I know you are the top expert in terms of a stable coin and also in terms of US dollar hegemony. I won't miss this opportunity to raise a question to you, which is also a great honor. And to put it short, do you believe, I mean, a lot of people are questioning the US dollar hegemony. They say that it may come to an end, but in my personal opinion, all the other currencies, whether it's euros or renminbi of China, are not yet in that position. So, but do you believe that the stable coin will be a game changer to this trend, or it'll be it means because of the Genius Act, all the other major economies in the world have not yet taken decisive steps in terms of stable coin. So do you think this stable coin will continue the US dollar hegemony? Thank you so much. Thank you.
So thank you for the question. I would answer it by saying many things are happening in the digital sphere. Even more things are happening to transform financial markets, which are continuously evolving. So I probably would not put stablecoins at the top of my list. I do think that there is more potential for tokenized bank deposits, for linking fast payment systems, even for central bank digital currencies. But that is a question that we're going to continue to debate for some time. You also raised the unavoidable, the inevitable question of dollar dominance and will it continue? So when I'm asked that question, I struggle to hold in my mind 2 points at the same time and to answer the question with 2 points at the same time. Point number one is that, yes, dollar dominance remains intact for the moment. The peculiar correlations between the dollar exchange rate and interest rates on April 2nd has basically died down again, return to normalcy. And as you said, the alternatives, including the euro, are not yet ready to step up and fill the dollar's shoes were the US to vacate them. That's point number one. And point number two is I think the threats to dollar dominance are greater today than any time in my lifetime, because they extend not only from policy uncertainty in the United States, which can undermine confidence in the currency, to threats to fundamental institutions in the United States, which can undermine confidence in a country's currency, threats to rule of law, separation of powers, good governance. Jiffer talked about graft before. So, the system we know dominated by the dollar remains intact for the moment, but I'm more worried than ever about how long that moment will last.
Thank you very much, Professor, for your insightful explanation. Thank you so much.
We have another question. Would you like to come in the front and then you can ask Professor Eichengreen personally?
Hello, many thanks for your presentation. I'm Leonor Coutinho from the European Commission. The disclaimer applies. A question is, are we, given all this that is happening, are we in Europe mispricing dollar risk? I mean, we see a lot of questions about the international role of the dollar, about the safe haven status. In Europe, there is a lot of exposure to dollars. European banks dominate in the euro-dollar market. Are we in Europe mispricing risk in this area, in your view?
I think there has been, the wake-up call has been received in Europe that holding dollars, that there is a tail risk, significant tail risk derived from the policy uncertainty and the institutional uncertainty that I described before. And I think that banks, reserve managers, others in Europe are moving as fast as they can to diversify, which is to say they're not moving all that fast because of the shortage, absence of alternatives to the dollar in terms of safe assets and as a means of cross-border payments. So the euro is important for cross-border payments in Europe's neighborhood, which is to say to the east and to the immediate south, but not more broadly. And the shortage of safe assets, as Daniel Gross and I wrote about a few years ago, derives from the fact that only 3 or 4 European sovereigns have AAA ratings from all the rating agencies. So there are solutions to these problems, but they take time to implement. The weakness of the dollar in 2025, I think, reflects the fact that people who use dollars in Europe and elsewhere have been hedging their dollar exposure, and buying those hedges puts downward pressure on the dollar. So I think it's prudent to continue to hedge and to continue to ask the question that you just did.
Then I think we are going to wrap it up for the day. Thank you very much, Barry, for joining us here in Brussels on the screen. It's been a fascinating talk and a very nice afternoon with a lot of food for thought. For everyone here in the audience, this conference, you can read about it on paper. The January-February issue of Intereconomics will feature contributions from all of our participants. And so you can review, you can come back and revisit. All of those papers will be based on their presentations here today. And that is available online at intereconomics.eu. I hope everyone has taken a few of the copies from outside. I would like to thank my colleagues, Cinzia and Ekaterina, and thank everyone here at CEPS for welcoming us into their space. And hope you have a lovely evening, and we'll see you next time.
Thank you. Okay, thank you.